anticipation of some points in the Wall Street Journal and the Financial Times that hinted at maybe this being an active conversation about a 50 basis point cut on Wednesday. Look, bottom line is, it really has to do with the projections out. I want to lean on what Deutsche Bank was saying and something, that conversation we've had here. It doesn't matter as much 25 or 50. It matters the trajectory and the dot plot. We're going to be talking a lot about that.
We will.
And some of the guidance in the press conference.
And the dispersion as well as some of the forecasts, how wide the range is on the FOMC. This is unlocking another leg of dollar weakness. So dollar yen broke 140 for the first time this year, trading in the 130s for the first time in 2024. Dollar yen down to about 140 flat right now, Lisa. We're negative 0.6%. So that's some Japanese yen strength on the screen. That's some euro strength on the screen. Euro dollar 111.28.
And how much is this baking in a 50 basis point cut for the Federal Reserve that will add to this dollar weakness? And how much is it just that you have a Japanese economy moving in the opposite direction? The Bank of Japan on deck potentially on Friday to hike rates again. A lot of people don't think they're going to, but they're poised to again. Are we at peak dollar weakness for the moment, or do we see a lot more? Note after note, dollar weakness is probably not going to be that much more pronounced, but that might be the gradual trend going forward.
Is the bulk of the move behind us? A conversation on that in about 15 minutes' time. Under surveillance this morning, the FBI investigating a second apparent assassination attempt on former President Donald Trump. Secret Service agents opening fire at a man with an assault rifle at Trump's West Palm Beach golf course just yesterday. A suspect identified as Ryan Ruth is in custody. Donald Trump is safe and unharmed. Thank goodness.
Thank goodness. We'd be having a very different conversation today if that Secret Service agent inside the golf course didn't see this rifle poking through the fence. What kind of conversation would we be having this morning? This individual is about 300 to 500 yards away. I think what's really coming into focus now is how to protect the former president, given this is the second assassination attempt on his life. The FBI is involved. This is going to go to the federal authorities. But really what came into focus yesterday was what the Palm Beach County Sheriff said, which was that potentially the parameter by which the Secret Service has in terms of protecting the president would be bigger if it was a sitting president. Joe Biden has come out and said, though, that they want to make sure that he's given every protection and precaution necessary.
Another shocking turn of events over the weekend. We'll be in touch with the team down in Washington all morning. Any updates as we get them, we'll share them with you. I want to turn to this story. Jeffrey's saying possible Volkswagen plant closures this year could pave the way for more than 15,000 job cuts. The automaker could close production facilities without needing approval from the supervisory board, leading to possible provisions of as much as $4.4 billion in the fourth quarter. This all according to the analyst, Lisa, over at Jeffrey's.
And shows the heightening concern over in the German auto manufacturing sector as you do have this increasing pressure from Chinese manufacturers and others. I spent some time with Mario Draghi's memo over the weekend, and this idea that he kind of wants Europe to embrace a U.S. type of model in order to avoid some sort of stagnation. The difficulty in doing that with all of the red tape and with the pushback that you've got, what is the logical outcome if they can't? And really that, I think, is what you see a lot of these automakers struggling with.
Also, potentially, how much is the negotiating tool? This is from a memo from Jeffrey's. They're citing comments from VW made during a roadshow in North America. Quote, unions should feel pressure to reach new agreements while VW will be in a position to force layoffs. So potentially this brings more people to the board because we know that the union is on the supervisory board.
There is a lot of excess capacity in European auto manufacturing right now, and how that gets resolved, reconciled over the next year or so could be pretty brutal. Elsewhere, investors preparing for a big week ahead with the Fed taking center stage on Wednesday. Fresh economic data also in the pipeline with retail sales tomorrow and jobless claims on Thursday. Neela Richardson of ADP writing, it would be easy to ignore the economic news this week and pay attention only to Wednesday's Federal Reserve vote on interest rates. I caution you don't. Even with a Fed meeting on the calendar, there will be much more important data news to watch. I'm pleased to say that Neela is with us around the table. Neela, good morning to you.
Good morning.
Let's start there. Let's start beyond the Federal Reserve decision. Jobless claims Thursday, retail sales tomorrow morning. What are you looking for?
The strength of the consumer. What's unique about this potential cutting cycle? First of all, the Fed hiked rates 11 times. So this could be a really long game. It's not just a one and done move, as we all know, and we don't know how long it's going to take, but it's going to depend on the strength of the consumer. And so when you look at retail sales, when you look at consumer spending, the bulk of the economy, if the consumer is still holding up, what that means is that the Fed is going to be cutting into a pretty good economy. And we don't have a lot of benchmarks for what that looks like.
How would you characterize where the economy is at currently? differently. If I look at the data and just the levels, we can get to the change and how important the change is, but the levels are still pretty decent. Unemployment around 4%, jobless claims in at around 230. If we listen to the companies, some of the consumer-facing companies have been warning about a weaker consumer. Dollar General, an example of that. Ally Financial last week, a decent example of that. How are you seeing things?
If the Fed was in this economy 15 years ago, I think we'd have a different conversation. This is a pretty good economy. Yes, there's some things to be concerned about. I'm really concerned in the jobs market about how segmented the concentration of hiring is, how weak manufacturing is. For the consumer side, I am concerned about the very low savings rate, very much lower than historical averages. I'm always concerned about housing in this economy because it's such a driver of inflation. But when you look at these jobless claims that'll come out on Thursday, I think what you'll see is pretty moderate low levels of initial jobless claims signaling layoffs. What we're not seeing is big job losses. That's unique in a Fed rate cutting cycle.
Some people might argue that's a lagging indicator, and we don't see the layoffs until it's too late for the Fed to act, which is one of the big arguments why doing the right thing means cutting 50 basis points on Wednesday. The note of caution that you had in your recent writings was household wealth as well as housing prices, and how that indicates a very different consumer in terms of resilience than some of these other peripheral weakening data points that people point to. Why is that?
Yes, the criticism with the Fed is that they always act too late, and that's why the job losses are a lagging indicator. But yeah, in other times when we've seen this huge increase in home equity, and we have, homeowners are sitting on record levels of home equity because of rock bottom mortgage rates before the pandemic and super high house prices. That's really driving a big explosion in household wealth. Well, in previous times when equity was this high, what households did was they just refinanced, tapped that equity out and bought cars, went on vacations, paid off student loan debt. They did all these things that actually leads to more consumer spending and gives a pop to the economy. Will they do those things again when mortgage rates come down, when it's less costly to refinance? I think so. You're sitting on a lot of wealth. That wealth could be an ATM for future, especially if savings rates are down. And housing wealth is a little easier to tap into than stock market wealth. More households have access to housing wealth. Home ownership is at around 65% in this country, which means that a lot of people are sitting on some money, and they may want to access that to fund their spending and purchases.
That said, some people might argue that this market is already priced in well more than 50 basis points of rate cuts. And what you see in the actual benchmark rates that are the borrowing costs, the pegs to a lot of borrowing costs for consumers currently, they already reflect that. So why not just do it and then allow things to sort of evolve from here? Do you see any real reflationary type of pressure kind of building in markets that should really push back aggressively against that idea?
I think one comment during those Jackson Hole meetings that was played but maybe ignored this week is President Harker's comments that the Fed needs to commit. It's not just about this 1 month. It's about the commitment that they illustrate over the next several months. And if they commit to a moderate rate cutting cycle, I think that will give some ease in terms of the market's ability to project the next move. If it seems like we're going to be data dependent, we're going to watch each month, it might be 50 basis points next month or the month after, maybe we pause. If there's some uncertainty, I think that's going to cause a lot of gyration in the market.
Neela, when you say there's no foregone conclusion on inflation, you point to housing.
Yes.
And then you look at, say, Kamala Harris's housing plan of a $25,000 subsidy. How inflationary is potential policies like that?
I don't really think they move the needle, and here's why. The demographics are behind a housing tailwind. If you look at the demographics in this country, Gen Z, millennials reaching peak home buying age, there's plenty of demand. You don't even actually have to amplify it. What there's lacking is supply. That's the issue. And so you have to have that two-tier housing plan. I think there's been some good plans that both meet supply and demand, but without inventory increases, we're not going to solve this issue of very low vacancy rates. We are at like half the historical rate of vacancies, 0.8% of all housing is unoccupied. That's super low. And that means housing is going to continue to put pressure on prices and inflation.
I guess one of the big issues, though, is that you can get the subsidy quicker, potentially, than there actually would be.
I mean, It's
The
short-term,
houses.
long-term. House prices are really high. They're unaffordable for many people. And they're unaffordable because of high mortgage rates. We might get some relief on there. They're unaffordable because people can't save because housing costs are so high. So you need a down payment. That might be helped by a little bit of money coming their way in terms of a down payment. And they're unaffordable. The big reason why it's unaffordable is because of inventory. So that is the big picture solution that has to be solved.
Just to put a bow on it for the people tuning in, 25 or 50 Wednesday?
I think it's 25.
25?
I know. It's controversial,
It's
but
what
I
it
think
is.
it's 25.
25 became controversial in the last week. It's something, isn't it, how things have shifted. Neela Richardson there of ADP, and of course a Bloomberg contributor. This just in from the former New York Fed President Bill Dudley: the Fed should go big now, and I think it will.
And this, to me, follows some of his previous comments. He explained why. He said that there are two objectives to the Fed's mandate: price stability and maximal sustainable employment. Since they have come much closer into balance, it suggests a neutral benchmark rate by the Federal Reserve. They say they remain far from it, and therefore it matters getting there quickly to try to stave off any kind of increase in unemployment. And he said the goal is to give a better sense of the destination rather than the pace. And if you move quickly and you get there quickly, that will actually have a much more beneficial kind of effect on the overall economy.
Things are so finely balanced. We'll keep returning to that article. It's on Bloomberg Opinion this morning. We'll come back to that in about 5 minutes' time. Equity futures on the S&P 500 just about unchanged, with an update of stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Donald Trump is reportedly safe and well after a second apparent assassination attempt. Authorities took a 58-year-old man into custody at Trump's golf course in West Palm Beach, Florida. Secret Service agents had spotted an AK-style rifle barrel sticking out of a fence about 400 yards away from the former president, who was playing golf at the time. U.S. and British officials are increasingly concerned that Russia is supplying Iran with nuclear weapons technology. Western officials tell Bloomberg that they fear the Kremlin is trading nuclear secrets in exchange for ballistic missiles to use in its war with Ukraine. President Biden is set to meet with Ukrainian President Volodymyr Zelensky at the UN General Assembly next week to discuss his war strategy ahead of the U.S. election. Disney and DirecTV have reached a contract that will restore customers access to Disney-owned networks like ESPN and ABC. DirecTV agreed to pay market-based rates to carry the channels. It also secured rights to offer a skinnier package of channels for fans of sports, entertainment, and kids programming. The channels had been dark since September 1st for roughly 11 million DirecTV subscribers during those negotiations. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on this program, testing dollar dominance.
Now, much of the world would like to get away from the dollar, but what we are seeing is a curious phenomenon where the dollar remains very dominant in all of these respects.
That conversation just around the corner. You're watching Bloomberg TV.
Artificial intelligence. Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
As
we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Doing okay. We're just about unchanged on the S&P. We're spoiled. Best week of gains on the S&P 500 this year, just last week. Saw the same move on a Russell. Really, really decent week of gains as well on a Russell. Small caps participating, big tech participating. I have to say, Lisa, we mentioned this a couple of times. Financials, I think, maybe the weak spot last week. A bit of uncertainty around the signals we were getting from Ally Financial and JP Morgan alike in conference season.
It was sort of the 1-2 punch, net interest margins under pressure at JP Morgan, and then questions around consumer creditworthiness on the other hand. It's sort of this difficult scenario that's hard to reconcile at a time where otherwise other signals seem to be really positive, both about the consumer as well as the broader economy.
Signals from the bond market and the broader economy. Broader economy seems to be okay, looking at jobless claims exclusively, specifically, yet you're still going to get those interest rate reductions, anticipating what we might get on Wednesday. Bond yields this morning down just a touch on a 10-year maturity. The 10-year at the moment, 364.75. Under surveillance this morning, testing dollar dominance.
It's going to be difficult to shift away given the dominance of the dollar in practically every dimension as a medium of exchange, as a unit of account, and as a reserve currency. And now, much of the world would like to get away from the dollar, but what we are seeing is a curious phenomenon where the dollar remains very dominant in all of these respects. I think we will end up in a system where the dollar is still the most dominant, perhaps a little less dominant than it is right now, and there is a lot more fragmentation, which means there is no serious rival to the dollar.
So here's the latest. The US dollar falling to its weakest level of the year, with currency traders gearing up for a trio of central bank decisions from the Fed, BOE and BOJ. Skylar Montgomery-Koenig of Barclays writing, the dollar typically weakens ahead of Fed cycles. The move has already been chunky by historical standards. We're still at a stage when bouts of further dollar weakness are likely, but a large part of the dollar move is probably behind us. Skylar joins us now for more. So Skylar, let's pick up on that last line. Why do you think the bigger chunk of the move might already be behind us?
Yeah, I'll give you a few reasons for that. I mean, the first is just positioning has shifted massively, right? We've gone from being max bullish long dollars on our sentiment indicator to max bearish dollars, and it's ticked up a little bit, but that sentiment is certainly still bearish. The other reason I'll give you is that you have previous historic easing cycles, and what you see is you do get dollar weakness into the first cut, but it's very front-loaded. After the first cut, the market realizes that either it's a hard landing and you need safe haven flows to the dollar, and that supports the dollar, or it's a growth scare. It's not as bad as was originally thought, and that means U.S. growth is still strong, and that can feed positively into the dollar as well. And the main reason there is because in soft landings, the market overestimates how much easing the Fed actually delivers, and we think that's what's happening now as well. There's too much dovishness priced in the U.S.
So let's put aside for 1 minute the idea of Fed expectations and go to this question that was raised in the earlier commentary about what's the alternative? How much could the other side of the trade, whether it's a Bank of Japan hike on Friday with more hikes indicated later on, or potentially some sort of action from the Bank of England that is less than people had expected? I mean, the other side of the trade, how much could that send more dollar weakness?
Yeah, I mean, this is the hard bit, right? It's from a growth perspective, certainly there's not an impetus from the other side of the trade. Europe looks exceptionally weak. If you think about the U.S. and China as being the global growth engines, the U.S. is the only bit that's really chugging along right now. China isn't stimulating the rest of the world. It's not happening in Europe. It's not helping the U.K., and it's, not feeding into commodities and thus these cyclical currencies like Aussie and CAD. I think on the interest rate bit, the big difference between the U.S. and Europe and the U.K. is they're significantly more priced in the U.S. And so I think the issue is because there's already that differential, you'd imagine that even if you expect more from the U.S., you need a closing of that gap in terms of more dovishness priced in Europe relative. And so, yeah, we are going to see less from these banks this week in terms of these are meetings where the Bank of England's not likely to cut. It's a meeting where the Bank of Japan is likely to stay on hold because they're assessing what happened after the hike. But, the growth backdrop isn't meant, or it's not pro having a divergence in policy to the extent that the market prices.
Skylar, how much does it matter to you whether the Fed cuts by 25 or 50 basis points on Wednesday?
Yeah, I think certainly for the dollar, it'll be quite binary for this week. In terms of the markets kind of pricing 50-50, we've had this rapid shift from the data indicating it should be a 25 basis point cut to kind of commentary and news saying that maybe it should be 50 basis points. And that means that when we get to this meeting, you could have a binary reaction where if it is 50 basis points, the dollar sells off. And if it's 25 basis points, the dollar rallies. Beyond that point, though, more medium term, it matters where the landing zone is. And that's the overarching theme that we're talking about in terms of we think we get to a 4% terminal rate. The market's pricing under 3%. It's very hard to price more than that. If you think we get a soft landing, then you think you're going below neutral, you're going into easing territory. And that indicates that you're thinking about a recession more, which should also be dollar positive. So yes, it certainly matters for the price action in the coming weeks, but I think more medium term, it's where the landing zone is that does.
Skylar, when you take all this into account, obviously everyone is laser focused on what the Fed does, but after that and the politics come into focus, what do you make of Trump talking about debasing the US dollar?
Yes. So yes, Trump has called for a weaker dollar, but most of his policies are actually dollar supportive, right? And we think the cost of weakening the dollar would be too high. In terms of how he could, there are options. There are three kind of avenues you could point to. It could be fiscal consolidation, it could be eroding of the Fed's independence, or you could do direct intervention. On fiscal, I just think there's very little political appetite. On monetary policy, I think there are institutional checks that make it less likely, but I think we'd also say that keeping monetary policy unnecessarily loose would spur inflation. So that's, again, a very politically unpopular option. And then just on direct intervention, I think multilateral interventions seem unlikely because you have dollar counterparts and they're unlikely to want to take the export hit from a stronger currency. And then unilateral intervention, historically, it's not done very well, but it would probably also necessitate Treasury selling, which would raise yields, which again is not something that they want to do as an option. And so any option that you could take to weaken the dollar, I think, is unlikely simply because it's too high a bar to pay to get there.
This call is not straightforward. Skylar, appreciate your input. Skylar Montgomery-Koenig there of Barclays on the US dollar in the next 12 months or so. Normalizing interest rates is only one piece of this. Trying to understand White House policy for the next 4 years is almost impossible. Growth differentials and rebalancing growth differentials, I think, is the key point that Skylar's making there. There's nothing convincing happening out of China. Maybe it changes with fiscal policy, don't know. In Europe, there's nothing convincing happening there either. In fact, Europe faces the very real chance that they have to face what we went through in 2022 in this country with technology, but in 2025 they have to do it with autos. And if they go through some kind of auto recession where you have to see all that excess capacity get reconciled, get resolved, get cut, the job cuts that come with that, the outlook for Europe is not great at all.
This is the reason why arguments about debasing the dollar in this sort of dramatic way with central banks moving away from the currency have fallen a little bit hollow, because what is the alternative to take its place? People could go to gold, people can go to Bitcoin, but the reality is, as far as another major currency, hard to see.
Hard to see, very hard to see. Bit of dollar weakness again on a page on the screen right now on the S&P 500 equity futures, just about unchanged. Let's call it unchanged. Going into a big week ahead. We've got a Federal Reserve decision on Wednesday. We've got retail sales tomorrow morning and jobless claims on Thursday to look forward to. Looking forward to the next hour of programming on this show. Savita Subramaniam of Bank of America, Terry Haynes of Pangea Policy, Michael Harrigan of the Pax Group, and Krishna Mamani of Lafayette College. All of that and more still to come from New York City this morning. Good morning.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching the close.
Get ahead of tomorrow's trading with The Close, weekdays on Bloomberg. Context changes everything.
It's almost a certainty at this point that we're going to get 3 cuts.
By the time we get to the end of next year, we're probably going to have seen somewhere in the region of 150, 200 basis points of rate cuts.
As we go forward and the cycle begins to ease a bit, that is going to take some pressure off.
The last thing they would want to do is overcut and then be in a tighter predicament.
The risk is if you go 50 first, the market will say, what do you know that I don't?
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now on a 5-day climb on the S&P 500 and struggling to make it day 6. Equity futures just about unchanged, going into a massive week ahead, leaving behind the best week of the year and looking ahead to Wednesday. On Wednesday, a Federal Reserve decision in the mix. It's a 3-part act. You get the decision, the forecast, and the news conference. The day before, though, the economic data, Lisa, retail sales. Can this tip the balance, tip the scales towards 50 versus 25?
You know, last week I would have said absolutely not. We would have already been settled. And right now I say absolutely yes. This is going to tip the balance because it's ultimately we haven't been settled in terms of whether the weakness is enough for the Fed to cut. Doesn't matter, though. I keep going back to this Bill Dudley op-ed in Bloomberg, former New York Fed president, where he makes the argument for a 50 basis point rate cut, saying what should it do and what will it do, the Federal Reserve? The answers to these two questions don't necessarily have to be the same, but this time around, I think they will be.
And he talks about the logic of supporting a 50 basis point cut is compelling. My favorite note has to come from Michael Froley, though, saying that what the FOMC will do is less key. What we're sticking with our call, they will do the, quote, right thing and cut 50 basis points. Feels almost like a morality call.
Everyone's got something to say on this decision. Steve Major of HSBC with this to say, for all the talk around the Federal Reserve decision on Wednesday and whether it will be 25 or 50, we really need to know more about where the rate will settle in a year or so from now. You've talked about this repeatedly. What's the destination? What are we playing for here?
They didn't even want to talk, though, about a neutral rate in Jackson Hole. I'm talking about Federal Reserve officials. If they don't want to talk about the neutral rate, how do they speak about a destination when they haven't gotten clarity on exactly what this current economy is? Are they just going to declare victory over inflation over the longer term and say this is a non-inflationary economy akin to pre-pandemic? Or are they going to come out and say neutral rates 3.5%, that's where we're going. See ya.
Can you imagine if they did an ECB, meeting by meeting, and offered no forward guidance whatsoever? Brutal.
That wouldn't work, period. And that, I think, is what a lot of people are saying. They need to provide guidance. Their dot plot will provide guidance. And so then, to Bill Dudley's point, why not go 50 basis points and just say, we're going to cut by 100 basis points. We're going to cut 25 at the next few meetings, unless there's some big shock. And we're going to front load it to get there more quickly. And that sort of gets ahead of arguments that might say, if you really thought the destination was 100 basis points lower, why not cut big now?
25 or 50, you will have plenty of arguments. That's just about all we can guarantee this week. If you are just tuning in, a lot of work to get through. On the S&P 500, equity futures just about unchanged. In the bond market, yields going nowhere. We're down to about 364.38. The dollar going somewhere, and that's south. The weakest US dollar of the year so far. Euro dollar at 111. Dollar yen, Lisa, a little bit earlier in the session, a brief break of 140 for the first time in 2024.
I keep going back to this statistics from Kit Jukes that the net longs from CFTC futures have gone to the highest level on the Japanese yen going back to 2016. To me, the whipsaw is just shocking. We went from a massive short position that led to the weakest yen in more than 2 decades to suddenly the biggest long position since 2016. This is a market that is very position driven, and you have to wonder how much that creates these whipsaws that don't create clarity.
Stronger Japanese yen on the screen, 140.08. Coming up this hour, Savita Subramaniam of Bank of America Global Research with a warning for big tech. Michael Harrigan of the Pax Group on the failed assassination attempt on former President Donald Trump, and Krishna Mamani of Lafayette College on the odds for a soft landing. We begin with the big issue on Wall Street. U.S. stocks looking to add to their best week of the year on bets the Fed will kick off the easing cycle on Wednesday. Savita Subramaniam of Bank of America writing, we remain underweight information technology despite arguments it has gotten so beaten up. Tech's concentration risk introduces the risk of passive selling, pressuring mega cap names. Savita's with us around the table. Savita, good morning. It's good to see you.
Good morning. Great to
Got to start with Wednesday, haven't we? 25 or 50. What's the house view?
House view 25, but I mean, I think we're all acknowledging there's risks of 50. I guess the idea is that our view is that the terminal rate settles around 325, 350. So that's what we're sort of tethering our market expectations to. The idea that inflation is cooling, rates are going down, but not to the lows that we saw pre-pandemic, to your point. So we're not going back to that sort of disinflationary environment where you've got, zero interest rates forever. And I think that's what puts pressure on tech and some of these areas of the market that are still very loved and very crowded.
So what should be loved? What should be a little bit more crowded?
I think you want to be in safe dividends. And I know this is the most boring call of all time, but sometimes boring is good. And, when you think about where we are today, we're in an environment where short rates are coming down. Think about all that money that's moved into money market accounts, retirees looking for income, looking for, investments they can live off of. As the Fed cuts, to 3-ish or wherever they settle, that income goes away, but inflation remains high. Retirees need real yield, and where we see that is in utilities, financials, real estate, in the S&P 500, areas that might not seem safe, but today I think they're higher quality than they have been in a very long time.
How did you make that argument last week when we were seeing, in particular in the banking sector, some difficulties?
Some difficulties, yes, indeed. So banks are not, the banks are always taking the hit for anything that's going on that seems bad in the world. But I think right now we are at a point where the yield curve is steepening. You've got the Fed telling us their next move is a cut rather than a hike. We've got an environment where financial services companies have a lot of levers to cut their costs. We've got, I think generative AI is a big kind of transformation story for financial services. For me, I fully expect to be replaced by a bot or a process. I mean, I think this is an area where we haven't seen any efficiency gains in a very long time. And we're now at a point where maybe we're at peak regulation, at least for the SIFIs and the big banks. We've got this new tool that allows us to analyze reams of data very quickly without, having junior analysts sit around overnight. I mean, I think this is a transformation for the sector. So I think there are a lot of arguments for financials, besides the fact that the big banks are the only area that are left to lend. If you think about it, if all these politicians want the economy to keep going, who's left to lend? Private sector, they've picked up the slack and they're starting to show some signs of fraying. Regionals starting to fray, they've picked up a lot of the loan growth. The only area of the U.S. economy that's left to lend are the larger
Can we speak to Brian directly?
regulated banks.
I just want to speak to Brian directly. Don't replace Savita with a bond. Don't do that. Is that what you're expecting? I hope that doesn't happen.
Actually, my question was, I mean, how many fewer people are they going to end up having? Actually, Deutsche Bank put out this report where they said that they had this proprietary model, ChatDBT, they call it informally, where they put basically the Wall Street Journal and the Financial Times articles in, and then it spit out what the bias was in terms of Fed forecasting.
Exactly.
But it gives a sense of exactly how much these banks are doing with it. I mean, how much do you expect some of these staffs to shrink over the next couple of years?
I mean, I think it's a good thing. I think that we're all going to be more productive. Those of us that are left.
Going on vacation.
But I think that, you know, like any technology, it replaces some jobs, but it creates new jobs. And it's exciting, right? I mean, when I look at the labor to sales ratio of financial services, it's only gotten worse. Every other sector has mostly gotten more labor light. Financial services has gotten more labor intensive. So I think this is an area that's, you know, kind of ripe for cost cutting, for efficiency gains. I think real estate is a really interesting area of the market. We've got dividends, we've got income. You know, when I think about retirees, my dad used to own REITs. Now he owns mega cap tech. I think we're going back to an environment where retirees own REITs, you know, MLPs, yield, utilities, and that's not, you know, one of the core holdings of the average retiree's fund at this point.
You haven't mentioned energy, and you say it's gone from value to value trap. Why?
Energy, I worry about a little. I mean, first of all, we're heading into an election where the outcome could be very different in terms of supply, oil supply. Second of all, when you look at CapEx to free cash flow, it's started to creep up. And I think we're in an environment where we want to be buying CapEx takers rather than CapEx spenders. So that's one of the areas where we're seeing free cash flow actually start to come down a bit. We're seeing massive earnings revisions. Our energy team, led by Francisco Blanch, is more negative on oil prices over the next 12 months because of supply and demand. So I think that there's an argument to be made that it's not time to buy energy. Deep value, it might be a little bit too early, but wait and see how the economy shapes up and stick with utilities as your way for getting exposure to commodities.
You mentioned politics. Were you surprised how well fossil fuel companies did under the Biden administration?
No, I mean, I think that this is what's kind of fascinating about energy is that it's done the opposite of what you would expect under each administration, right? I mean, under, you know, the Trump years were actually quite bad for energy stocks. And then, you know, under Biden, we saw energy really rally. I think part of it is just the fact that energy and oil was being assigned a terminal value of 0. Then we realized we're not going to get off of fossil fuels that quickly. There's also this sort of manufacturing renaissance taking place in the U.S. that puts some demand under, you know, commodities and oil. But I think let's say for the short term, I think oil and energy stocks look a little bit risky because the reason they look cheap is that prices have fallen faster than analysts have downgraded their earnings expectations. So that's the sort of classic value trap.
Zooming out, there's a real question about whether this market is fully priced to soft landing and whether the Fed can sort of keep that going, the last gasps of it this week on Wednesday with potentially a 50 basis point cut as well as some sort of forecast. How much can this market kind of rally given the fact, even with a soft landing, given the fact that you don't see big tech as a participant and possibly some of the other high flyers either?
Well, you know, our year-end target is 5,400, which is below where we are today. And I think the idea here is you see some give back in these stocks with high expectations that maybe are going to take a bit longer to deliver. But you do see kind of a re-rating in other areas of the market. So when I look at the landscape of size and style, I think large cap value looks incredibly attractive right now because, first of all, when you think about where investors are going for income and yield, they're not going to buy small cap value, too risky. Large cap value is banks, it's energy, which we're neutral on, it's real estate, it's companies that haven't really had access to capital for a very long time, and now they're sort of trained to survive in a higher interest rate, higher real rate environment. I think the idea of navigating a soft landing is probably more feasible today because think about where the excess is in the economy. We're not seeing an environment where consumers are sitting on massive levels of debt. Corporations have actually taken advantage of low interest rates and have locked in fixed rated debt. I think we're in an environment where the public capital markets look much higher quality. Maybe the risks have shifted to private lending, areas that are less liquid, real estate. I mean, I worry that if the Fed actually starts cutting and we start to see mortgage rates come down, that reset for home prices might actually be lower rather than higher, because we've been stymied by an environment of no price discovery in housing. Nobody's willing to walk away from their mortgages. So it's a weird world, but I think that things could do, we could be in a kind of an opposite environment of the typical easing cycle.
We've got one of those mortgages around this table, so we'll leave that there. I want to finish on utilities.
Yes.
Utilities are up by more than 20% year to date on the S&P 500. You mentioned the sector. It seems like this odd sector where it's everything to everyone. What is this trade? What are we getting into?
Look, I think utilities is sort of the steady Eddie. In fact, we have this chart that that my former boss, Rich Bernstein, used to publish that shows that the total return of the S&P Utilities Index versus the NASDAQ, almost always neck and neck. And it's really the idea that if you get this dividend and you reinvest it in these boring companies, right now maybe they're a little more exciting because of this power AI story, but I think you've still got this sector where you kind of know what's going to happen. They're regulated, they pay a high dividend yield. You reinvest that and you actually do just as well as you would in sexy tech stocks over the long haul. It's kind of an interesting analysis, and I think that's where we see a catch-up over the next few years.
You're certainly doing very well in that sector this year. It's good to see you. I hope you're never replaced. I will not interview the robot, okay? I promise that. Savita Subramaniam there of Bank of America Global Research. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Donald Trump is reportedly safe and well after a second apparent assassination attempt. Authorities took a 58-year-old man into custody at Trump's golf course in West Palm Beach, Florida. Secret Service agents had spotted an AK-style rifle barrel sticking out of a fence about 400 yards away from the former president, who was playing golf at the time. People familiar tell us that hedge fund Eisler Capital has lost about 10 money managers in recent days. The departures include people leaving voluntarily and those the firm has dismissed. Returns at the $4 billion hedge fund have been stalling as it attempts to transform itself into a multi-strat fund away from its roots in just macro trading. FX's Shogun broke records at last night's Emmy Awards. The feudal Japan drama won 18 awards in total, including Best Drama and Best Actress. That's the most for a series since 2008. Other winners include Hacks for Best Comedy, overtaking The Bear, and the surprise breakout Baby Reindeer winning Best Limited Series. The Bear, though, didn't leave empty-handed. It won many individual acting awards, including Lisa Colon-Zayas, the first Latina to win Best Supporting Actress in a Comedy. And that's your brief, John.
Danny, thank you. Shogun, nothing better. Just like right up there. Just absolutely brilliant.
I couldn't agree more. It's sort of Game of Thrones, just consolidated with more intrigue.
So good. And we get a second season, right?
I know, which I'm really excited about, but Marco's gone. So
I know, I feel
really?
the same way.
Hey, I was like, the show is over.
No spoilers.
Sorry.
I'm next on this program. That wasn't good. Another attempt on the former president's life.
Former President Donald Trump is safe and unharmed. The Secret Service did exactly what they should have done. They provided exactly what the protection should have been.
Another shocking twist in this campaign in 2024. That conversation just around the corner from New York City. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
This is an apology on behalf of the whole team at Bloomberg Surveillance as Lisa Brambett single-handedly ruins Shogun for everyone who hasn't watched it yet. Anything to say?
Including me.
I own it. Sorry. I'm like, come on. It just, you know, I'm so excited.
You relate to it. I guess you just assumed everyone else had seen it.
Exactly. People, if you hadn't seen it already, you already got spoiled. So basically, this is, you know, you're welcome.
Anne-Marie's sitting around the table thinking, I did not see it. I haven't watched it. And now I'm probably not going to.
Oh, no, I'm already getting hate mail. Sorry, guys.
Sure. Equity futures on the S&P look like this. We're just about unchanged. 5 days of gains on the S&P 500 through Friday, coming into Monday. In the bond market, yields settling down at about 364. In the FX market, the dollar at the weakest levels of 2024. Euro dollar 111.16. Dollar yen around 140. Under surveillance this morning, another attempt on the former president's life.
Former President Donald Trump is safe and unharmed. Following a protective incident shortly before 2 p.m. on Sunday, the U.S. Secret Service personnel opened fire on a gunman located near the property line, and this matter is under investigation. The Secret Service did exactly what they should have done. They provided exactly what the protection should have been, and their agent did a fantastic job.
So here's the latest this morning. The FBI investigating an assassination attempt on former President Donald Trump at his West Palm Beach golf course. Sunday's incident, the second one in 2 months, plunging the 2024 race into further chaos just weeks away from Election Day. Terry Haynes of Pangea Policy joins us now for more. Terry, it's another shocking twist in this campaign in 2024. What does it change, if anything at all?
You know, I don't think it changes anything, John. And, you know, and sadly, we have some precedent for this. You know, just about 2 months ago was the attempt on Trump's life. And I said then, and turned out to be right, that I thought that Trump wasn't going to get any lasting benefit out of it. I think that's still true today, largely because Trump has a hard voting ceiling. In other words, everybody that says they're going to vote for, that's going to vote for Trump is already saying that they're going to vote for Trump. So I don't think this makes much difference.
Terry, when you look at what happened, though, in Pennsylvania, 2 months later, another attempted assassination attempt on the former president's life. And then you have the Palm Beach County Sheriff coming out and saying, well, maybe if there was a bigger protective perimeter, this individual wouldn't have been able to get in. Why is he not being secured as if he is the sitting president? Not saying he is, but being secured on someone who does have these attempts on his life.
Well, I'm not going to pretend to be amateur expert here, but I was involved in a lot of the discussions about the Capitol perimeter after 9/11, but that's another story. I'm still not going to be Mr. Expert here. But Congress needs to get to the bottom of this, and by getting to the bottom, I mean that the relevant people on the committees need to come back. They need to immediately get briefings. They immediately need to figure out what the Secret Service did and didn't do and how to correct it, and they need to do all that within the next week or so. Throwing more money at this problem is not going to help if you can't figure out what the best perimeter is going to be, and Congress has an oversight responsibility that so far it isn't taking up with the alacrity that it needs to.
Do you think this task force is doing a good job, given the fact that it was built on a bipartisan basis from the first assassination attempt?
I'm sure they're getting a lot of briefings. I'm sure they're gathering a lot of evidence. I do think, though, that you get 2 months past the event, you better know all the knowns and be ready to act on it, because we're in the middle of a presidential campaign, and we're in a situation where, heightened security, any incumbent President Biden, whoever the next president is going to need to respond to threats and need to anticipate those threats, apparently better than's been done in the 2 Trump attempts. And, I think the institutions of government here are not acting commensurately with the threat and the peril that's involved here for anybody, not just President Trump.
At this point, when you look going forward, how does this change the narrative, not necessarily for Donald Trump's campaign, but for Kamala Harris's campaign?
Well, I don't think it changes the narrative very much. I do think that at all, frankly, I do think that what ends up happening is that Harris continues to grind it out in the swing states and keep enthusiasm high. If there's any adjustment, I think they maybe adjust a little bit against personal attacks on the president or hyperbolic themes that may overstate his case. I'd bet on at least in a short term, a little subtle adjustment on that. And again, we saw that in July, but then within 2 or 3 weeks afterwards, which turned out to be the Republican convention, everything ramped up as if normal. Those adjustments may last a little bit longer this time.
Terry, given the fact that we have congressmen and women heading back to the Capitol today, what is your expectation in terms of them getting a CR through Congress and keeping the government open till the end of the year?
I'm sorry to say that I think what we'll see is the familiar scenario of brinksmanship, where a very few members see it as in their political advantage or in the party's political advantage to have some sort of performative shutdown. I don't think that lasts long. I don't think it's a big deal. So markets, I think, frankly, ignore it. But underneath, I want to point out to markets, too, that it emphasizes the unseriousness of what's going on in Washington. You have 2 political parties, one of which wants to continue to spend fiscally as it has done. The other political party thinks the idea of bravery is to cut 1% off of 30% of the discretionary funding. Neither is addressing the fiscal debt and deficit problem that markets are increasingly concerned about.
Terry Haynes of Pangea Policy with an important point to end things. Terry, thank you, sir. The important point here really is that whoever is in power, they have a very different view when they're not in power on whether we should be disciplined or not, with the purse strings down in Washington.
Which is the reason why Gary Cohn, who previously was the chief economic council director under Donald Trump, coming out and saying there's very little political appetite to increase the deficit. There's always political appetite to increase the deficit. This is the reason why people are watching when the bond market will push back, because until they do, it's going to be status quo, and that is what it is.
Well, to pick up on Terry's point, what they're fighting in Washington, D.C. is such a small sliver of the pie. This is where all the policy is done. But until they decide to go after what is going on with Social Security and Medicare, there's really no way to fix what's going on fiscally in Washington.
Bond yields this morning, at least, they're falling. They're not climbing. We're down 2 basis points on a 2-year at 3.55. On a 10-year yield, we're down about a single basis point. Your yield at the long end of the curve, 3.64 on 10s. On 30s, just short of 4%. Coming up on this program, we'll catch up with Michael Harrigan of the Pax Group and formerly of the FBI as federal officials investigate a second attempt on Donald Trump's life. That conversation up next.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
How much hate mail are you getting?
I'm getting a lot. I'm really sorry.
On
I didn't mean
Shogun.
to.
Is it that serious? That sounded so sincere.
Well, it was
just then.
sincere because I recommend still watch it. Let's move on. I feel really bad.
And there's a second season coming too. Enjoy it. Every futures right now on the S&P 500. Negative by 0.06% on the S&P. We're just a little bit softer on the Nasdaq. We're down 0.4%. The outperformance, just relatively speaking, again, you see it on the small caps. The Russell up by 0.6%. This in from Ian Lincoln and BMO. Odds of 50 basis points are increasing, and they certainly are, going into Wednesday, looking for the first interest rate cut since the pandemic and looking potentially for a 50 basis point move. Switch out the board and get to the bond market. The two-year yield declining last week in the face of a hotter CPI, a hotter PPI, and not a bad jobless claims data point on Thursday, and yet still, bonds rallied.
Buy the rumor, maybe sell the news, or buy the rumor and then also buy the news. Basically, there was this shift, and whether it was a series of articles that came out in the Wall Street Journal and the Financial Times, or whether it was a series of potential officials and former officials who came out and supported 50 basis points of a rate cut on Wednesday. Either way, this is a market almost fully pricing it. They're fully, say 40% or a 40 basis point rate cut is now baked in at a time where the data doesn't show weakness, which is basically nirvana for risk assets.
The bias in the bond market is just phenomenal. The bias to buy fixed income every time yields back up. The bias to ignore strength and embrace weakness every time we get data in America. We'll catch up with Manny Roman of PIMCO in about 30 minutes' time on this subject. There is a massive bias to buy bonds in America over the last month.
Without a real question or without a real answer to what the destination actually is, and that really will be the key question on Wednesday. There is an issue of how much bonds can yield at a time where people are racing back to the bottom, even though a lot of people say we're still in an inflationary environment. It isn't necessarily 25 or 50 basis points on Wednesday. It is a question of that neutral rate that they're trying to get back to, and the fact we don't know what it is.
This move in yields unlocking some more dollar weakness. The US dollar started this morning at the weakest levels for the year so far. Dollar yen breaking down to levels we haven't seen since 2023. Dollar yen briefly south of 140. 140.07 on dollar yen. On euro dollar, 111.21. That's some euro strength and a ton of dollar weakness across G10 on the session this morning.
And this is front loading a lot of the rate cuts in addition to maybe a soft landing type of scenario that allows trickling out to other currencies. It also comes with a potential Bank of Japan rate hike on Friday. There is this issue, though, of how far it can go given the fact that there are a number of economic problems, whether we're talking China or whether we're talking about Europe.
And the outlook for tariffs and policy coming out of the United States. Under surveillance this morning, this story. Donald Trump's running mate, J.D. Vance, saying Trump's plan to hike tariffs on U.S. imports would help offset a growing list of tax cuts. Trump proposing to end taxes on tips, overtime, and Social Security benefits, along with a 10% across-the-board tariff that could spike up to 60% on goods from China.
I have a lot of questions about this, and I go back to what Lori Calvasina said, which is basically I left also the economic speech Trump gave in New York with a lot of questions on exactly his plans for tariffs and when it comes to his tax policies and whether or not the 15% corporate tax rate would benefit all U.S. companies or just those that have some sort of domestic component at home when it comes to manufacturing. But when it comes to tariffs, Trump said this in a Bloomberg Business Week article. He said, man, I'm so confused why so many people are against tariffs. It is good for negotiation. Will this be a blanket, quickly put the walls up around the United States and ring fence the U.S., or will this be a negotiating tactic, which Scott Besson told us maybe 2.5% on Chinese goods for 24 months until you get to that 60%?
Anne-Marie talking, is there more clarity? I think not on your part, but with respect to policy, the answer is no. There is this issue of, can you really bank on anything from either side to create an economic policy and an economic narrative? And the answer is, for a lot of analysts out there, not so much.
There are many reasons to introduce tariffs. We've talked about so many of them to protect domestic industry. If you want to use them to influence behavior, this is the question I would be asking people on the campaign trail. What evidence is there that tariffs in America across successive administrations have actually influenced the behavior of the Chinese, particularly at a time when China is failing to get in line with the Europeans, with the Americans on very key foreign policy issues? The tariffs stayed. Have we actually displayed any success whatsoever in influencing Chinese behavior? I would suggest very little.
Especially because there have been some backdoor ways for them to avoid them, in particular having to do with the chip sector, in particular having to do with certain technologies in auto manufacturers. The question is going to get a lot more difficult when it's not just blanket tariffs on consumer goods, but when you're talking about some of these high security aspects that recently they're increasing some of their crackdown on.
Should we talk about one of those loopholes? I had no idea this even existed. White House officials poised to crack down on a loophole, allowing low-cost goods to be imported from China tax-free. The US planning to begin taxing packages worth less than the previous limit of $800, a move directed at the rise of bargain shippers like Alibaba, Temu, and Shein. I didn't know there was this loophole, but there you go.
To me, again, I was shocked that there was this loophole, and why does it exist? And I have to say, as much as some people, even in my own household, have gone to some of these and even gone to different knockoff brands to try to knock off some of the luxury players for cheaper goods from China, as much as they might lose out here, why is this in existence? Will this be difficult for them to get through at a time where it seems like a no-brainer? It just highlights, going back to the point we were making earlier, we say whether these tariffs have been effective, what are these crackdowns? There still are so many different apparatuses in place to make it easier for Chinese manufacturers selling into the U.S.
The reason why you guys don't know this exists is because you're not targeted by these cheap products, by Shein, especially in the fashion world, because you're not on TikTok, you're not on Instagram, and this is where they are starting to pick up these teens that want fast fashion at a really reasonable price.
That's why we're not shopping on Temu. No TikTok account. That would change.
Evidently. I'd be a lot hipper if I had a TikTok account, evidently.
Possibly. Lisa's still apologising, by the way, for those of you just tuning in for completely spoiling
Oh my
Shogun.
God. Are we going to do this all morning? Just keep bringing it up again and again?
Ruined it
Possibly.
for me.
Okay.
Possibly. Let's turn to a much more important story. The FBI is investigating a second assassination attempt on Donald Trump at his golf club in West Palm Beach, Florida. Secret Service agents reportedly spotting a rifle barrel sticking out of a fence before opening fire and apprehending a 58-year-old suspect who is now still in custody. Joining us is Michael Harrigan of the PAX Group, who is also a retired FBI Farms Training Chief. Michael, welcome back to the program. I'm happy to catch up with you, sir. Unhappy to be speaking about the same subject again just 2 months later. Michael, just tell us from your perspective why it's proving so difficult to secure and provide security for the former president.
Well, you know, Mr. Trump, you know, he moves around as he likes. I mean, obviously he's under Secret Service protection, but, you know, he likes to get out there. He's known to love golf, outdoor venue. I think what you have here is you have to look at each threat and each attempt independently and look at what the background of these are. And both seem to be where there was some planning, and it was a point where he was vulnerable at that moment. So it's a tough one here to have two so close to each other, or should I say two on one candidate. That's unheard of. And this points to a very high threat level for the former president, and one that may call for rethinking his security and for Mr. Trump potentially to rethink how he goes about his daily life.
Well, Michael, that's what I wanted to ask. When you look at the near term right now and protecting the president, is it about changing his schedule or potentially changing some of his habits and what he likes to do? Or is it about changing the Secret Service?
You know, that's a two-sided knife there. Both sides have to be assessed. But, you know, when you come down to it, if you're not the number one thing for vulnerability, if you're not available to be attacked, that's your primary defensive measure, not to be where you could be attacked. Now, the Secret Service, again, they took a very hard look at them. You know, Congress and American people have been asking questions about Secret Service since the Butler incident. On this situation, though, we don't know enough yet. It sounds, from what we can see, is that the Secret Service performed phenomenally in interdicting this threat before the man could take the shot or take an effective shot at the president. So Secret Service did well here. But I think you have to look at the overall structure of where he was, a public street. Anybody can stop a car and jump out anytime. This guy obviously crawled into the bushes where he was concealed. So, you know, I think that both sides have to be looked at. But I think the primary thing here is for Mr. Trump to consider changes to his schedule now, however uncomfortable he might find that to be, and remove himself as a potential target out.
Well, this individual is 300 to 500 yards away from Trump while he was golfing. And the Palm Beach County Sheriff said yesterday that if Trump was the sitting president, we would have had this entire golf course surrounded. Should they have done that? Should they start expanding the perimeter?
Well, I think it's a duality here again, is that, Secret Service has to obviously make some changes in how they might protect him if he's on a golf course. And I can guarantee you that from this point forward, he's not going to be in this position on a golf course. Secret Service is going to step up and do what's needed. But, you know, you look at the balancing the public inconvenience of shutting down those major roads there in that area. To shut those down while he's playing golf is a huge inconvenience to the public. Obviously, in light of this situation, a reasonable cost to be paid, though, a reasonable cost. So, you know, both sides have to be looked at. And, frankly, Mr. Trump may have to listen closer to his Secret Service advisors there and just make those changes, at least in the lead up to the election. It's only a couple months away. Obviously, he's got to get out there and go to his rallies and engage with the American public. That's what he enjoys doing. So that can't be interfered with. And they are taking very good measures there when he's in public at official events. But it's these private events like this where he's so-called off duty on his own time that now we see how vulnerable that can be. And it's a lesson to other presidential candidates out there for them to reassess how they go about their personal lives. It's a very frustrating time in this country to see this happening. And it's a critical time for us to maybe make some changes.
Given your prior work at the FBI, do you think this individual was watched, that given the fact that he, according to his Twitter account, which has now been shut down, has gone over to Ukraine and he claimed he was fighting on behalf of the Ukrainians? Was this individual, do you think, flagged previously by the FBI?
You know, he could have been, but when you look at the breadth and depth of people that travel overseas or may have political views, I mean, it's a staggering amount of persons that could be potentially looked at by the FBI and maybe a file opened on them. Nothing substantive can be found because it's simply First Amendment speech. So then it's moved on, and they move on to other more relevant, more current threats. So just the fact he traveled overseas probably isn't a point of the Bureau looking at him. It would be more of what he's saying and what his footprint is on social media and what he said maybe to, in the public arena in other ways, whether he's a threat or not.
And Michael, just to go back 2 months,
Ukraine,
if I can jump in, sir, if you don't mind. Are you surprised how little we know about the motive behind the first assassination attempt only 2 months ago and the lack of detail between then and now? Are you surprised by how slow this process seems to be going?
To a point, I mean, I think the primary point here is to find out if both these individuals had connections to a foreign government, to a larger conspiracy. But unfortunately, what you see in some of these, what we call lone wolf actors here, that act on their own motivation, they may have minimal communication with others that could become a red flag and a chance to report and interdict these threats. So these individuals are out there. It's the same with the individual that shot at the Republican congressman on the Hill. He wasn't able to be interdicted beforehand because he was a lone wolf. He was on his own, decided to do this on his own. And same with these. very difficult if they're not having conversations with others and talking about their plans. You lose that opportunity. Or if they're part of a conspiracy or a group that's under surveillance by the government, then the government has the opportunity to look at those communications and potentially stop these threats before they materialize.
Michael, we hope we don't have to have this conversation again. Michael, thank you, sir. Michael Harrigan of the Pax Group and formerly of the FBI after a second attempt on the former president's life in just 2 months. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The yen is around its strongest level in over a year. The currency appreciating for a 5th consecutive day. It did briefly fall below 140 versus the dollar this morning, but is now back just about at 140. This morning, it's mostly the dollar side moving on nearly even odds for a 50 basis point cut priced into markets. The Fed's decision comes Wednesday. The BOJ's on Friday. Intel shares higher pre-market by over 1%. People familiar telling us that the chip maker has officially qualified for as much as a $3.5 billion in a federal grant to make semiconductors for the Pentagon. That would add to a possible $19.5 billion in grants and loans awarded to Intel through the Chip and Sciences Act. As of the Friday close, the stock has fallen some 61% this year. Now, those $8 lattes may become more commonplace. The cost of premium Arabica beans this morning surged to the highest level in 13 years. Coffee futures as a whole have surged around 40% this year. There's been shortages of the cheaper Robusta beans, and that's boosted demand for the premium Arabica variety favored by coffee buffs. There's been concerns also about harsh weather in Brazil that's fueled the rally. Brazil currently grappling with its worst drought in decades. And that's your brief, John.
Danny, thank you. More from Danny in 30 minutes' time. Two views, two very different takes. Earlier on this morning, the former New York Fed President, Bill Dudley, making the case on Bloomberg Opinion the Fed should go big now. I think it will. Moments ago, Steve Englander of Standard Chartered, good reasons not to cut by 50 basis points. This one, I keep saying this, it is so finely balanced going into Wednesday.
And a real question of whether it matters ultimately, given the destination, how much they can telegraph that, given they will have a dot plot, they will have a statement of economic projections.
Up next on this program, a split decision.
We're looking for a 25 basis point rate cut, but for them to really signal they're going to do a sequence of cuts here. A 50 basis point cut, it suggests to us that they're more worried about downside risks to the economy.
That conversation around the corner from New York. You're watching Bloomberg TV.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
You're you're going to get this all week. This from Steve Englander of Standard Chartered. Good reasons not to cut by 50 basis points. The economic data has not made a compelling case for a 50 basis point cut at the upcoming meeting. Goes on to say cutting by 50 and being wrong would likely be worse than cutting by 25 and being wrong. What do you make of that argument?
It's arguably the exact opposite from what a lot of people are arguing. So you can pick the argument you like. You can make an argument either way. Problem for me is how much does it matter if you do understand the path, if you do understand how much they're going to cut this year. But then the second question is, if you think that 50 basis points of a cut is going to be the bigger mistake, does that mean that you think that inflation is still very much a risk, lurking beneath the surface, ready to rear its head once more?
You'd have to imagine that's what he means by being wrong. You'd have to imagine that might come up on the FOMC in the debate over the next 48 hours or so. Equity futures right now unchanged. Going into all of this on the S&P 500. In the bond market, down almost a basis point. The 10-year 364. And in the FX market, as we've said all morning, the dollar near the lows of 2024. Euro dollar 111.23. Under surveillance this morning, a split decision.
The Federal Reserve should be focused on moving policy rates back to neutral. And I think the question at this point is just how quickly they get there. We think they probably will revise down their own estimates for the rate path. In September, we're looking for a 25 basis point rate cut, but for them to really signal they're going to do a sequence of cuts here. A 50 basis point cut is if they end up doing it, it suggests to us that they're more worried about downside risks to the economy.
So here's the latest. Treasury's gaining with all eyes on Wednesday's Fed meeting. The debate on Wall Street now 25 versus 50. Krishna Mamani, preach. I hope they trot somebody out. Set us up for a 50 and relieve us of our misery ahead of the meeting. Somehow I don't think it's likely. If we're going to have a hard landing, 50 won't stop it. It is too late for that. Krishna joins us now for more. Krishna, I just agree with you, sir. I think we all do. This is getting tedious. This from Steve Englander, and I want your thoughts on this, and welcome to the show. Cutting by 50 and being wrong would likely be worse than cutting by 25 and being wrong. Krishna, what do you make of that logic? Do you agree?
Well, so I think the point Steve is not articulating is the fact that the Fed is bound by its mistake in 2021. That is, in their minds, if they cut by 50 and you have reacceleration, that's a bigger challenge than if you have if they cut by 25 and things continue to slow down, because they believe they have a lot more space to cut rates over the next 12 to 18 months. However, if there's a reacceleration, it's on them altogether. So I think that's what the Fed is dealing with rather than the economic reality.
So what is the economic reality, Krishna? I mean, this has sort of been the big mystery. You said that ultimately is really what's going to be at stake in terms of determining the path of risk assets.
Yeah, so I think Dudley today articulated the economic reality quite well, which is, look, growth today is quite decent, 2.5% GDP now. Inflation has come down. Relative to inflation, short rates are too high. They can cut 50 basis points. Whether they will or not is really the issue. Is there enough room in the rate structure today for them to be aggressive? And absolutely. Is there weakness enough for them to kind of go whole hog? Absolutely not. And I think that's the challenge that they're dealing with.
What does whole hog mean, though, Krishna? I guess that's really the key question, given the fact that people are saying, some people are saying 50 basis points would move the needle on what market expectations were for the full year. Bill Dudley's argument is, if you think that neutral is substantially lower than where we are now, why not get a rapid start to it? Otherwise, why aren't people going to ask, if you think neutral is 150 to 200 basis points below where we are now, why not move a little bit faster to get there?
Oh, absolutely. I think, again, they have the room to move faster. However, I think, as Dudley also argues, is the fact that they got a head fake in the early part of this year. And they don't want those head fakes, because that would, doing a 50 ahead of an election, then end up with the head fake would probably be far worse for the credibility of the Fed than anything else. But as you have been articulating, that's really besides the point. I think they will articulate a very aggressive rate cutting path. And I think in the end, that probably matters a whole hell of a lot more than anything else. What we are dealing with is a situation where inflation is coming down, rates are high, economy is doing reasonably well. So there's a negativity vacuum, and we are trying to create some drama in the middle of all of this.
So, Krishna, let's get the market call. Let's think about how far bonds have moved. The 2-year topped out just north of 5% earlier on this year. I think back in spring, back in April, we've had a move of about 150 basis points lower at the front end since then. We've had a round trip in equities. Call it a growth scare, call it August, whatever you want to call August. We're back close to all-time highs on the S&P 500. Krishna, given those moves, as you start to think about the balance of risk into year end, more upside risk or downside risk? What is the bigger risk for you?
So I think as far as bonds are concerned, at these levels, unless you think we are really going to have a recession or that probability goes up, I think the upside, that is lower yield upside in bonds is limited in my judgment. And you know, it's not that we are probably going up meaningfully higher. It's just that we just sit around here for a long period of time. Having said that, I think if actually probability of recession increases, and we won't find out till probably middle of 2025 whether that is the reality or not, rates can move very, very substantially. I think the challenge with equities is the valuation. You know, the environment is right, but environment is right along with the fact that we have already incorporated all of that information in our pricing. So upside is limited there as well, and a recession, the downside is quite substantial.
So what does that mean you're doing, Krishna?
I'm sitting tight from a risk perspective, and has been the case for a few months. Hasn't worked out too badly with the special emphasis on bonds. That is, if you had some spare money, investing in bonds makes more sense because it can run away from you. Equity markets are not going to run away from you.
Krishna, just quickly, invest where in bonds?
Invest in the short end of the market. I think you'll be, you know, still. Cash is yielding pretty good, and at this pace, it'll yield pretty good for a reasonably long period of time. And if you don't, if your expectation is that we are going to have a soft landing, which is the case for me, the upside in buying longer bonds just doesn't exist anymore.
Okay, Krishna, thank you, sir. Appreciate your input. Good luck for the rest of the week. Try and get through it. Krishna Mamani of Lafayette College. I think we all feel the same. Peter Cheer feels the same too over at Academy. Good luck. I wish the Fed would come out at 10 a.m. Eastern time so we'd have less time to second guess every position and view.
Basically, we're all sick of this conversation, and yet we're going to be having it for the next 48 hours. I do want to just note that what Krishna just said there was not what a lot of fund managers want to be hearing. You know, stay in money markets.
They've got things to sell.
I mean, they've got things to sell, and this isn't working for them.
If you find this tedious, wait until the next one, November 7th. That's going to be quite a meeting for the FOMC, 2 days after the general election.
Yeah, I don't know that that's going to be tedious, though, because they're going to have to take a look at who won the election and what the economic projections most likely are going to be at a time where that also is an uncertainty vacuum. I mean, negativity vacuum. I love that idea. I hope we stay in a negativity vacuum for a while.
I hope we know who won the election 2 days after the election. That might be wishful thinking.
It might be wishful thinking because some of these states cannot start counting their mail-in ballots, notably Pennsylvania, until the election is over on November 5th, so it might take a few days.
Coming up on this program, here's a lineup for you for the third hour of Bloomberg Surveillance. Manny Roman of PIMCO, don't miss that. Greg Dacko of EY, Megan Robson of BNP Paribas, and Bloomberg's Ira Jersey. It's a big week ahead. The third hour of Bloomberg Surveillance up next.
I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investment that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issues, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. The top names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
There is a real risk the Fed is falling behind the curve here.
This Fed tends to move slow. They're watching with a rearview mirror.
The recent loosening in labor markets just suggests that there is some possibility for overshooting.
It's now about next year and the year thereafter where there's much more uncertainty.
It's not just that we don't know what the destination is. We don't know what the journey is.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now with an absolutely fantastic lineup for you. Equity futures on the S&P 500 just about unchanged, coming off the back of a 5-day winning streak and involving the most tedious debate of the year so far. It's become tedious, that's for sure. 25 or 50 at the Federal Reserve on Wednesday.
The reason why this is so tedious, let's examine the tedium that we have to discuss for the next 48 hours, is because we also don't know how much it will matter. Because ultimately, it is not just about 25 or 50, it is about how the market responds to it. It is about how it is telegraphed going forward. It is about the destination. It is about how Jay Powell dresses and how he sort of intonates when he gets to the press conference.
We used to do that with Draghi ties. Do you remember that? Yeah, and then it became Lagarde scarves and stuff like that. Just ludicrous stuff. Things are so finely balanced, there is a real belief on the street right now that a soft retail sales print or a firm one could tip the scales in one direction or the next. We've got retail sales tomorrow morning, and then we've got jobless claims on Thursday. Is that going to be what tips the balance here into Wednesday?
Well, it's because the market was pricing in 25 basis points after the jobs report, after inflation, and now all of a sudden, after an FT, a Wall Street Journal article, and we should note Bill Dudley's comments and an article in Bloomberg Opinion, now the market is pricing in 50 basis points. Potentially the next shoe to drop where they can maybe change their position will be retail sales.
The former New York Fed president making a case in Bloomberg Opinion to go big, and he thinks they will. It's not just a case to go big. It's that he thinks they will go big on Wednesday afternoon.
He cited the articles in the Wall Street Journal and the Financial Times as a good sort of sense of how the debate was evolving, talking about how they could avoid getting criticized for not getting to the destination more quickly if they went by 50 basis points. If you take a step back, it goes to this question of what is the bigger risk here, inflation or employment? Pretty much everyone thinks that right now, at the moment, it is economic weakness or economic potential softening. On the flip side, Neil Richardson talking about what we see in housing prices, what we see with household wealth, what we see with sentiment, it's sort of tricky to know.
At the moment, right now, there is a belief that it's more likely we get 50 than 25 based on market pricing. Coming up this hour, this is the lineup for you. Manny Roman of PIMCO. As markets await this week's Fed decision, we'll catch up with Greg Dacko of EY on why he's expecting 75 basis points of cuts before year end. And we'll speak to Megan Robson of BNP Paribas on why she's bearish on credit going into the election. We begin with a big issue on Wall Street, 25 or 50. Bond yields falling going into this week's finely balanced central bank meeting. The PIMCO team writing the post-pandemic inflation shock and rate hiking cycle produced a generational reset in bond yields. Central banks have largely succeeded in bringing down inflation to 2 point something and are poised to begin cutting rates, creating a compelling multi-year outlook for global fixed income. I'm pleased to say that the boss over at PIMCO, Manny Roman, joins us now for the next 30 minutes or so. Manny, it's good to see you, sir.
Good to see you.
Good
Thank you
morning.
for having me.
Put us out of our misery, 25 or 50 tomorrow. What's it going to be?
Well, we're in the camp of 25, but you know, I always say we have a crystal ball, and at the end of the day, we'll see what the market does. You know, it may very well be that it doesn't make that much of a difference, and our view is that there will be 3 cuts of 25, and at the end of the day, what matters is where we are at the end of the year.
Well, let's talk about the destination. This is a 3-part act on Wednesday, as you know. It's a decision, it's a set of forecasts, and a news conference, and a big conversation around this table for the last several months. What's the destination? What are they aiming for? What are they shooting for? Where does this land in the next 18 months?
Well, I think you can say that there's less inflation right now, and that in the absence of new data, the destination will be to have lower rates, and the Fed will be very data dependent. And I think sometimes one underestimate how careful they are about new data and how they want to be able to change their opinion. And so if you kind of use this framework, you sort of say, let's do 25 and then let's see where we are, and then probably do 25 and 25. But I think the total sum of the rate cuts may matter more than how they do it.
Which is the reason why people are looking forward and saying maybe the neutral rate's 3.5%. And oh yeah, look at that. The 2-year yield right now is about 3.5%. Back in June, when you put out the outlook for PIMCO, there was a feeling that intermediate bonds really had a fantastic investment proposition just simply because there was yield. Do they still, after the rally we've seen?
We still do think so. And listen, the exciting thing about being at PIMCO right now is that fixed income is quite attractive. And you know, we are in a business of feast and famine, right? So when rates are very, very low, it's harder to be that excited about fixed income. And when you can build portfolio and get a yield of 6.5, you become very excited. And you know, we're very focused on treasury. But the reality is there is a lot of value in other part of the segment, asset-backed being one of them. And you know, we're excited about what we see, and at the end of the day, the yield on the portfolio is a good predictor of the return that the investor will experience. And so what I think is exciting about fixed income right now is you can build a portfolio and get a return of 6.5% with a series of different instruments.
It used to be that bonds did better in bad times and worse in good times. Are we heading into a worse time where people go to bonds for safety, or is this on just an absolute basis, yields are higher?
My partner Dan Iverson, and I'm going to quote him because actually he has a very good line. Bonds may be the most attractive asset class, and I think that there's an absolute argument and then there's a relative argument. And I think the relative argument is to say, you need to build a portfolio, you need equity, you need fixed income, you need some real estate, you need some private asset. And at the end of the day, fixed income is much more attractive than equity given the earning yield and given the valuation of the equity market. And I think that's one of the arguments for owning a larger part of fixed income. And I think when I travel the world, I think that people are underinvested in fixed income, and a lot of them are looking at putting more money into fixed income, and whether they do it tomorrow, whether they do it 2 weeks from now or 2 months from now, I don't know. But the reality is people were underinvested various parts of the fixed income market, and they're looking to readjust their allocation.
Have you got confidence we've reestablished the inverse correlation between bonds and stocks?
I don't know what I don't know, and I think correlation fluctuate over time. I think that fixed income have a role in a portfolio construction, and I think they're there for a reason. But of course, credit spread in the high yield market are correlated to equity prices. So once again, I think one needs to be careful about how you frame the question and how you conclude.
Well, I guess I would be more specific by saying, have treasuries re-established an inverse correlation with equities? Because one of the risks that we've seen established over the last few years, particularly given the central focus was inflation, is that when bonds sold off, equities did too. Have we changed that story? Have we left that behind?
Hopefully we have. But I think remember that we also saw with the pandemic really an unprecedented program of money creation, which sort of threw everything and our economic textbook in terms of how we thought about the correlation. And so I'm careful about what I say because the data are just so skewed in terms of what we saw. And I think, you can make the argument, for example, that part of the reason why the US economy has done so much better than any other places is that the package in terms of the pandemic has been so much bigger than in other country. And at the end of the day, all you can do is cross-sectional analysis and try to compare different countries, but there's so many other variables that comes into the picture that you don't want to understate the enormous creation of great company in the US versus Europe, for example. And so I think we try to always be careful about making definitive conclusion when it comes to correlation and when it comes to cross-sectional comparison between different countries.
Another way to frame this question is when you travel the world and you talk to international clients who are underinvested in fixed income in the United States, how many of them turn to you and say, what about the US deficit?
Well, my friend and partner, Richard Clarida, used this very American expression and says the U.S. is, let me try to make sure I get that right.
Carry on.
The cleanest dirty shirt. And, we have debated quite a bit at a forum about deficit and deficit do matter. And they do matter. And at some point in time, there's a tipping point, but we're not there. And the reality is it's a huge competitive advantage to be the reserve currency. People need to own dollars. And the reality is we don't think there's a crisis coming and that the US can have certainly a high level of debt versus historical precedent and be able to function just fine.
When will the US get there? And do you see either party have any impetus to try to rein in spending?
So to quote my partner, once again, Libby Cantrell, who comes often here on the show, no, we see no impetus to try to deal with the budget deficit. The only real example we have is the United Kingdom. And I think that the United Kingdom was actually quite interesting because you saw a situation where the bond market reacted so violently to the Liz Truss proposal that all of a sudden they had to change really, really quickly. And I think that this example of what happened in a very developed country and how the Bank of England reacted really quickly with the LDI situation and the pressure in the gilt market and in the pension market will be a textbook example of why markets react quite strongly when something outrageous comes.
Well, we have a Bloomberg survey to that point that says Kamala Harris, a victory for her in the White House would be better for treasuries and worse for stocks, vice versa for the former president. Would you agree with that scenario analysis?
I think there's so many unknown. It depends on what happened in the House. It depends on what the winner can do in terms of program, how this is all going to pan out. I would be very careful about making any prognosis on this matter. I think when we think about the world, I realize politics is really important.
Yeah.
But at the end of the day, that's not how we invest. We invest because we find value and we find opportunity and we try to buy cheap and we try to manage portfolio and think about risk carefully and ride different cycle and deal with many other factors than politics. And there's a few exceptions. If you talk to my partner, Pramal Dhawan, in emerging market, all of a sudden, in emerging markets, sometimes politics do really matter because they are very big changes and very big different outcomes.
The struggle, Manny, as you know, is that some DMs have traded like EMs over the last few years. And you mentioned the UK, so I won't put words in your mouth. I do want your views. It does feel like a self-imposed debt break in the United Kingdom. And I'm wondering whether, from your perspective, for you and the team, that actually makes UK government debt a little bit more attractive here.
We think it's very attractive. We like the UK, we like Australia. We think that the UK fits very well in the portfolio, and they will need to cut rates significantly. And so when you think of a global outlook, the UK looks good for a fixed income investor.
Relative to the United States, say, in terms of duration risk?
Relative to other countries in Europe, certainly compared to European bonds. We also like the US, so, you know, if I want to kind of sum up things, you know, we like the US, we like the UK, we like Australia.
Okay. Manny, you're going to stick with us, I'm pleased to say. We're going to have more to say on both the markets and on the industry as well. Manny Roman of PIMCO sticking with us for the next 20 minutes or so. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Donald Trump is reportedly safe and well after a second apparent assassination attempt. Authorities took a 58-year-old man into custody at Trump's golf course in West Palm Beach, Florida. Secret Service agents had spotted an AK-style rifle barrel sticking out of a fence about 400 yards away from the president, who was playing golf at the time. The FT reporting this morning that Citi is stripping its chief operating officer, Arnan Selva, of his responsibility for a key piece of its compliance work. Citing 4 people familiar, the paper said the change follows a $136 million fine by regulators this summer for reporting failures. Selva's responsibility for data compliance will instead be passed to the bank's chief technology officer. And a new report finds that New York City's MTA transit system needs $115 billion of repairs and upgrades. The Citizens Budget Commission says the city should focus on repairing its current infrastructure rather than diving into expansion projects. The estimate, though, far exceeds available funding. The MTA must release its 2025 to 29 budget by October 1st. And that's your brief. John.
Danny, thank you. More from Danny in 30 minutes' time. Up next on the programme, we'll get you some morning calls, and later, Greg Dacko of EY weighing in on the 25 or 50 debate. Greg's coming up a little bit later in the programme. More from Manny Roman of PIMCO. Up next on the show from New York, this is Bloomberg.
Was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from...
Well, you've been quoted a number of times, Elon, on you'd like to die on Mars, but not on landing.
Yes. Yes, I was asked that in an interview if I wanted to die on Mars, but then I considered the corner case of dying on impact, and I'm like, except for that case. You know, you got to consider the various corner cases. So, I mean, if you're gonna die somewhere, might as well be Mars. I'd like to explore for a bit before, you know, dying. Yeah, I think we want to be a multi-planet civilization. And, like, I think...
I don't know if that's a response
that's
from the audience. Let's talk about that just for 1 second. Then we're going to take some questions from the audience.
I mean, I could accomplish this, actually, this year if I was willing to die on impact.
the fundamental invention that is necessary for humanity to become a multi-planet species is rapidly reusable, reliable rockets.
Yeah, I was trying to sound like a pirate. But yeah, rapidly reusable, reliable rockets. Space pirates for the win.
All right, here's some questions from the audience, Alon. Which one would you like to pick here?
Well, I guess let me maybe just touch upon why I think making life multiplanetary is important, because I think it's one of the things that gets us past one of the Fermi great filters. So in trying to sort of explain why do we not see aliens, there are various explanations for why we don't see aliens. Like what stopped those civilizations from expanding beyond their solar system, and what were the sort of they're sometimes called like Fermi filters. Well, if you don't become a multi-planet civilization, then you're simply waiting around until you die from a self-inflicted wound or from some natural disaster like the dinosaurs. You get hit by a big meteorite or something like that. Eventually something like that's going to happen. If you wait around long enough, the sun will expand to engulf Earth and will be incinerated. So that for sure is going to happen. Now, we've got some time before that happens. There are more near-term risks, but we want to try to get past the Fermi filter of being a single-planet civilization. Now, this is going to be somewhat cerebral to many people listening, but I think this is actually very important. We want to get past the Fermi filter of a single-planet civilization. The point is not to move from Earth to another planet and let Earth die. That's not what I'm saying at all. I want to be a multi-planet civilization so that we have planetary redundancy such that no single event can be the end of our civilization. That is the point of making life multi-planetary.
When the Fed cuts rate, eventually the short end of the curve becomes less attractive, and I think you'll see cash moving. And from a competitive standpoint, we want to do the best possible job in terms of being a fiduciary and doing a good job in terms of performance and being there for our clients, and we compete every single day. And hopefully we win more than we lose, but all we can do is try our best, and we're trying very hard.
Where's the edge? Where's the sort of growth concentrated in, or is trying to be concentrated with respect to PIMCO in the, say, 5 years ahead?
Well, Asia has been quite exciting lately, and there's a lot of things happening in Asia, and you can sort of think of a business as being linked to GDP in terms of the saving rates, and people, when they save more, invest more, and so Asia has been quite exciting. And the US is an absolutely wonderful place. I mean, it's a big market, and there's a lot to be done. We have a very good Canadian business. We have a very good Latin American business. There's a lot of good things happening. But the one variable we don't control is, of course, the macroeconomic situation. And so if you have a real reversal and you have, for example, a recession, and let me just say it's not our scenario, but if you have a real recession, people become more risk averse and take some money away. And at the end of the day, we're here for the next 20 years, not for the next 20 minutes. And so, we have very liquid portfolio. People can take their money whenever they feel like and reinvest and so on. And we understand that people need money for all sorts of reasons.
There are a number of behemoth asset managers. PIMCO oversees $1.8 trillion. How much bigger could you see it getting?
It's all about performance. And I always say the great thing about not being public and not having to give quarterly earnings is you focus on what matters. The circle of truth is if you perform, they will come.
You said this last time we spoke. Don't measure our success by assets. We measure our success by the returns we provide. Does it disappoint you? Is it slightly upsetting that people do measure your success by assets? Because they've been pretty stable now for the last decade. BlackRock over the same period has multiplied. Is that disappointing to you that people judge you by that?
I think we have a very different business model. And, we were talking about Walmart. We don't want to be Walmart. Walmart is a fantastic company, but we have an opportunity set where we very carefully think about capacity and how much money we can put to work and what the right target return are for investors. And I think that, by definition, means that we won't be the largest asset manager, and so be it.
When it comes to asset management, private markets comes up all the time, and everyone's trying to make their own push. Where does PIMCO fit into that big push at the moment into private markets?
So we try to focus on what we know how to do, and what we know how to do is fixed income, and so that includes, as a matter of fact, everything which has to do with private market and fixed income, and it also involves real estate. And there's a big real estate cycle that should be exciting. There will be pieces to pick, and there will be cheap investment, both in debt and in equity. And in the private credit market, there's quite a unique opportunity in asset-backed lending. That's where my friend Dan Iverson grew up in. We have been doing this for 20 years. And the one thing which has changed, so to speak, is the banks need to free up capital. And so they need to sell large portfolio of many different assets and do it fairly quickly. That's an opportunity for us. And so if they are good entry point and good asset to pick, we should be able to do quite well.
What types of assets? Are you talking about commercial, or are you going to be
Equipment
owning
loans,
big residential
mortgage,
swaths?
The trade coming out of it.
We've only got 60 seconds left with you, so the hardest question of the morning. What's more likely? Arsenal winning the title, Federal Reserve engineering a soft landing?
Arsenal winning the title.
Arsenal winning the title?
Yes.
Should I read into anything about your real views on the economy then, based on that, or you just think Arsenal's that good?
No, you should. You should think about Arsenal. No, I think, look, I think people are very, sometimes criticize the Fed. I think they do a really, really good job with a very difficult hand to play. And you know, they don't know what they don't know at the end of the day. And I think it has been a tremendously complicated market to navigate for everybody over the past 4 years. None of us ever thought we would see a pandemic. And you know, from an investment standpoint and from a regulatory standpoint and from the Fed standpoint, I think we had to learn a new playbook.
It's been humbling for us all. Manny, it's good to see you, and great win over the weekend. Thank you, sir. Appreciate it. Manny Roman there of PIMCO. Coming up on this program, Greg Dacko of EY and Megan Robson of BNP Paribas. The week continues to build. The anticipation continues to grow. 25 or 50 on Wednesday. A three-part act. A decision, a set of forecasts from the Federal Reserve, and a news conference with Chairman Powell. Going into all of that, a 5-day winning streak on the S&P 500. 1 hour away from the opening bell, with equity futures down just 0.1%. And in the bond market, yields lower by 2 basis points, with the dollar sitting near the lows of the year so far. Euro dollar, 111.27 from New York. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
It's Monday, 8:30 Eastern Time, and I know you're already absolutely sick to death of this, but it's going to continue for the next 48 hours. This from Andrew Honhorst of Citi, 25 or 50. Don't turn the volume down, stick with me. This is what he's got to say. Our base case is a 25 basis point cut on Wednesday, but articles in the Wall Street Journal and FT last week left the potential of a larger size cut on the table. This will come down to committee dynamics, arguing for the next 2 days, and Tuesday's retail sales report. In either case, we expect a dovish FOMC with the median dot for this year implying 100 basis points of cuts, which would mean at least one 50 basis point cut at one of the last or one of the next 3 meetings going into year end. Going into all of that and going into the opening bell, which is about 60 minutes away, your cash open is just around the corner, and equity futures are down by 1/10% on the S&P. On the Nasdaq, we're down 0.5%. On the Russell, some outperformance. The small caps up by 0.4, coming off the back of the biggest weekly gain on the S&P 500 so far. Let's get some morning movers with Danny Berger. Hey, Danny.
Hey, John. A little bit of sell-side action this morning. Colgate palm oil down some 1.5%. This coming from Chris Carey over at Wells Fargo, downgrading from neutral to underweight, saying that it's not weakness, it's just normalization, that the epic run for Colgate is over. Also doesn't help that there's been this huge defensive equity run that has left the stock more expensive than their peers. Meanwhile, over at Intel, it is a gain in the pre-market session this morning, up 1.5%. Bloomberg reporting on Friday that they've won a $3.5 billion defensive contract for the Pentagon to make chips for them. There's been some criticism from their peers saying that the White House, that the Pentagon is just too reliant on this one chip company that has had some issues. That's down 60% year to date. Nevertheless, shares up 1.4%. Wrapping things up with Apple, shares down 2.5%. Strategist Min-Chin Kuo saying that they've done pre-market checks, they've looked at supply chains, and the orders for iPhone 16 are weaker than anticipated. John, 13% down year over year versus the iPhone 15. It's because of competition in China, and that Apple Intelligence, that AI feature, you're not going to be able to get it with this iPhone 16 latest release.
I'm waiting for the AI goodies, and then maybe, we do the hardware upgrade, and then you get the AI goodies, and it might make sense. Until then, I'm not sure it makes sense for me. I don't know if it makes sense for you. Danny, thank you. Your week ahead looks like this. Federal Reserve decision Wednesday, sandwiched between some economic data. On Tuesday, retail sales. On Thursday, we'll get jobless claims. Out just moments ago, Empire Manufacturing. Mike McKee around the table with us for more. Mike, what have you got?
Well, this isn't a major indicator, but it is interesting because going into the Fed meeting, we're seeing some expansion in the New York region. The general business conditions indicator rises to 11.5 from negative 4.7, so a fairly large move. New orders, shipments, inventories all up. The only thing that's really down is prices paid, and the number of employees improves, but it's still negative. So there is some signs that the economy is hanging in. Whether you put a lot of weight on the Empire number or not, it is maybe a small thumbnail on the scale.
To be clear, we had another thumbnail on the scale last week. Jobless claims were pretty decent. Jobless claims have been okay for the last 4 weeks. There's still this real sense that we're so finely balanced that all it might take is a soft retail sales print to all but confirm They're going 50 on Wednesday. What do you make of how people are talking about this decision going into Wednesday?
I think it's the first time that we go into a meeting in years without knowing what they're going to do. And so and it's a finally balanced decision. So people are trying to guess one way or another, and you're basically bringing your own biases to it. Whether you think that the Fed should be doing 50 or 25 is what you're going to end up predicting at this point, because you don't really know. And to the extent there were leaks to newspapers last week, they didn't give you any kind of definitive answer. They just raised the question, the possibility that the Fed could do 50, so it gives the market something to look at if they want to do that and not freak out if they were betting 100% on 25.
Mike, what's the risk of this ambiguous approach, basically, as we head into the decision?
Well, it's probably more of a risk that they've put out the possibility of 50 if they did 25, because then the markets are going to react to that. But you've got the other side of, if they do 50, then what do they know that we don't know? Ian Lingen from BMO put it well this morning. He said, basically, the markets are going to price the next 12 months based off of what we get on Wednesday. And if you do 50, then they're going to start looking at 50s going forward at a more rapid rate down to whatever they think neutral is going to be, which was 2.7 last time.
Lots of buzz around the Bill Dudley piece, former New York Fed president, and Bloomberg opinion this morning. The Fed should go big now. I think it will. I know you've read the piece. I'd love your thoughts on it. What do you make of it?
Well, he makes a very good argument for his side. Greg Ip in the Wall Street Journal yesterday, published last night, makes the same case that the Fed is maybe behind the curve and it's better to do 50 now and get started on that so that you don't fall too far behind. The problem there is the people who make the case for 25 bring up the way the market's going to react to this.
Yep.
And so you've got some real countervailing views here, and it would be great to be a fly on the wall in the meeting. Normally, they go into the meeting with a decision pretty much made, because Jay Powell talks to them all on Friday, and they all tell him where they're going to be, and he can persuade people. But in this case, you get the impression that he's going to let people talk.
They always say every meeting's a live meeting. For the first time in a long time, as Mike said, this is the first time in a long time it actually feels like a live meeting. Mike's going to stick with us. Mike's in Lisa's chair. If you're wondering where Lisa is, she's run off for jury duty. She's hoping she's going to be back tomorrow. We hope she's all back tomorrow and not lost for several weeks. Joining us now is Greg Dakov, EY. Greg, good morning to you, sir.
Good morning.
I said as you walked into the studio, this is getting so tedious for so many people, because we all know that not all 25s are created equally. Not all 50s are either. And it's only one piece of the overall puzzle for the Federal Reserve on Wednesday. What are you and the team looking for?
Well, we're still looking for 25. We're not going to change our call at the last minute. I think there's a lot of movement in terms of market pricing that has come off of these two articles, the Wall Street Journal and Financial Times last week. But I think the uncertainty is still quite high. And as Mike was saying, it's all about how Fed Chair Powell manages to convince or not the rest of the policymakers. I think there's a strong split within the FOMC as to Fed Chair Powell, perhaps Governor Waller, open to front-loading rate cuts, to catching up a little bit, because they do realize that the economy is weaker than they had been anticipating. But most other policymakers still remain extremely data point dependent. And the data, as of the last few days, has not been sufficiently weak to convince them of a 50 basis point rate cut.
Let's start with the chairman and then get to the rest of the committee. I want to share two quotes with you. One was from the start of summer. The other quote was towards the end of summer, and both are from Chairman Powell. In Sintra, Portugal, Chairman Powell said, because the US economy is strong and the labour market is strong, we have the ability to take our time and get this right. Then at the back end of August, the end of summer, he said, we do not seek or welcome further cooling in labour market conditions. Given the data we've had since Jackson Hole, which chairman shows up to this FOMC meeting?
I think it's still the latter one, the one from Jackson Hole, saying that he does not seek or welcome any further weakening in the labor market. We have seen an environment where I think the main issue from the Fed side is the communication issue. We have seen a lack of communication as to a couple of things. One, the destination of travel, where the neutral Fed funds rate is, and two, how to get there, the destination. Those are the more important factors than whether the Fed goes 25 or 50 basis points. As Mike was saying, there is asymmetry around the fact that the Fed goes larger or smaller in terms of rate cuts. But what really matters in terms of how monetary policy is going to affect the economy is how rapidly we get to any form of neutral monetary policy stance.
When it comes to that communication, are you expecting clarity?
perhaps a little bit more clarity, perhaps a little bit more transparency in terms of the fact that the timing and the pace of rate cuts will depend on the totality of data. That may be a shift in the monetary policy statement, arguing for a framework that is a little bit more forward-looking. I think that's what we've been lacking all along. Data dependency was the main theme. This is a good slip of words, but data point dependency has become the norm. It was all right when inflation was rising extremely rapidly and you wanted to make sure you were really adopting the appropriate monetary policy stance. It's no longer optimal. You want to look ahead to where inflation is going to be in a year's time, where the labor market's going to be, and where income is going to be, because I've argued in the past that we're not paying sufficient attention to income trends. Income trends are much weaker than GDP data and consumer spending data, and income, in the end, is the main pillar to economic activity.
Well, if you think that, then should they go 50?
I think they should go 50, yes. I think they should catch up. I've been arguing for a while now that they should have started easing back earlier this summer. Why? Because you want to go gradually. When you're uncertain, you're rather better placed to essentially ease monetary policy gradually and avoid these hesitations, or what seems like hesitation, in going with larger rate cuts. So I think, yes, they should have gone earlier, and that may be one of the justification that Powell uses if the Fed does decide to go 50 basis points, that they did not ease in July. It may have been optimal to do so, therefore we're catching up. And that's where the whole dot plot discussion is going to come into play. How many rate cuts are expected before the end of this year?
Well, you said coming in that this is a communications issue for the Fed. What does Jay Powell say if they want to do 50, or if they do 25? Half of the people on Wall Street are going to be upset they didn't do 50. The other half, if they do 50, is going to be upset they didn't do 25. So what does he say? How does he sell this to the markets?
Well, I think he has a great opportunity to set up a framework in terms of the monetary policy setting. He needs to acknowledge the fact that we're traveling towards some point, and that we'll get there either fast or slow. That communication will be essential because, as I said, if the Fed does less than what markets are anticipating, then there's a risk of essentially a repricing in markets the other way. A lot of people were asking me, what does a 25 basis point cut really do to the economy? Well, not much. It doesn't lower consumer rates much. It doesn't lower mortgage rates much. What happens if the Fed does not cut is much more dramatic, because a lot of rate cuts have been priced in. So you'd see a significant increase in yields that would be much more dramatic and much more hurtful for the economy.
There's a lot of weight on this meeting because there is a real belief it sets the tone for the rest of the rate cutting cycle. I just wonder if we're overdoing that. How different things might look on November 7th, on December 18th, when we have more clarity on the outlook for policy down in Washington, D.C. Could they turn out to be the more pivotal, more important Fed meetings in 2024?
Perhaps, because we have a lot of uncertainty on the political front, as you well know. And one of the things that some have been arguing is that the Fed is just now catching up to the first stage of monetary policy. The second stage is what happens to the economy under different presidencies. Do we get an inflationary environment next year with more tariffs, reduced immigration, and more potential influence on the Fed? Do we get a scenario that's more likely to be a status quo type of environment where the economy continues to slow? That is highly uncertain. And so when the Fed does not know, it tends to go slow. That's the Brainerd principle, right? We're in this environment where there's a lot of uncertainty as to 2025. So let's focus for now, and policymakers should do that. Focus on the end of the year, focus on what you know, and adjust monetary policy to today's economic conditions and expected conditions over the next 3 months. And then in November, December, January, start to recalibrate policy as to what is expected on the policy front.
Clear thinking, great stuff as always. Greg, thank you, sir.
My pleasure.
Greg Deco of EY. Greg's view, essentially, we think they'll go 25, but they should go 50. The difference between what they will do and what they should do is 25 basis points. The difference between 25 and 50 for most of you is going to come down to very, very fine economic data points. And it could be tomorrow morning with retail sales just around the corner, tipping the scales between 25 or 50 on Wednesday afternoon. Equity futures going into the opening bound negative by 1/10% on the S&P 500. On the NASDAQ 100, we're down 0.5%, coming off the back of the biggest weekly gain on the S&P 500 so far, and on a 5-day winning streak on the S&P into Monday. In the bond market, we look like this. 2-year, 10-year, 30-year. On a 2-year yield, we're down by 3 basis points. On a 10-year, we're just about unchanged at 364, unlocking a little bit of dollar weakness against the Japanese yen. Dollar yen breaking through 140 earlier on this morning for the first time this year. Briefly, back to about 140.36 on a session at the moment. With us around the table now, jumping into the studio, Megan Robson of BNP Paribas. Megan, good morning to you.
Good morning. Thanks for having me.
We were just talking about how this story might change from September into November, into December, and take on more of a political twist. And when I'm reading your research and your views on credit, this is heavy on politics, isn't it?
Exactly. So our view heading into the next 6 to 8 weeks is bearish on credit. We think investors are sort of underappreciating policy risk. And typically when you head into an election, you see volatility rise. And given you have a binary outcome with 2 very different implications, investors tend to de-risk their portfolios, reduce risk positions, and that causes credit spreads to widen. So heading into November, we do think credit spreads will widen.
Is that a story about positioning and pricing and not policy? Or does policy factor into this?
I think policy certainly factors in. I do think you have 2 very different candidates. If you take an issue like corporate taxes, for example, if you get a sweep in either direction, you could see net income up 7%. On the other side, you could see net income down 7%. So I think that uncertainty and inability to predict either outcome really drives the de-risking into the event. Following that, I think depending on what outcome we get, we can see dispersion based on who wins in not only the presidency, but also in Congress.
Is your best case for the credit markets, though, to basically maintain what we have right now, which is gridlock in Washington?
Exactly. I think the best case for most investors is a divided government scenario where having a Democratic president, potentially divided Congress, means that we have status quo, not a lot of new policy. I think in a Trump scenario, a lot of folks generally assume that's going to be more pro-market, but in our view, there actually could be a lot of macro headwinds should we see new tariffs and potential trade war. And remember, a lot of that policy, you don't need a unified government to get. So that's irrespective of what happens with Congress.
So are you basically saying Trump is worse for the credit markets?
I think it's a little more nuanced than that. I think you do get a tailwind from potentially lower taxes. It would require a red sweep to get that, but there is definitely the risk of a headwind if we do see broad-based tariffs as he's proposed. He's proposed, as you know, 10% global tariffs, 60% on China. Whether he'll be able to get that extreme type of policy passed remains an open question. But in our base case, if he does do that, we would see a decent uptick in inflation, and then I think it's going to call into question, can the Fed actually resume this rate-cutting cycle, which is a headwind for credit?
Well, let's get to this rate-cutting cycle, 25 or 50. I want to spend some time on the 50. 2-part story. The first part is they go 50 and you're worried about them knowing something you don't know.
Yes.
The second part is they're going 50 and you're thinking they're getting ahead of the curve here is good news. Do we respond bullishly to this or bearishly if they go 50?
I think bullishly if they go 50. Credit is set up, in our view, for a 25 basis point cut. There is this assumption that potentially the Fed knows something we don't, but I do think they'll extrapolate, wow, the Fed's going to be aggressive. We're going to get growth that's held up okay with aggressive rate cuts, and I think credit initially would react very bullishly. We would see tighter spreads. Beyond the near term, of course, depending on whether we get a soft landing or a hard landing, that will ultimately drive where credit spreads grow, so we'll be data dependent. But initially, I think that would be bullish for markets.
Well, given your political outlook, does the market immediately, if the Fed does 50, price in 50 in November, 50 in December, and just an accelerated pace all the way along?
I think it's definitely possible that if we get the initial 50, there's going to be an extrapolation that we could see further aggressive policy, not only this year, but heading into next year. But we think that 25 is appropriate. We have a 75 basis points in our base case for 2024 this year, and then next year, 125 basis points. So I think that outcome is what is roughly priced into credit consensus. Anything more than that in the dot plot or in 50, I think will cause credit spread rally.
Don't you wish we could just get this decision done today?
Yeah.
At 2 p.m. Eastern time? Just get it done on a Monday, Mike? Get it finished with? You're all excited. I think
I'll go catch the plane right now.
The first live meeting in years for the Federal Reserve, but this one feels a bit tedious, doesn't it?
Well, it does in that sense, but what's going to be really interesting is to see what they put in their summary of economic projections is how do they see inflation and unemployment moving, since they pretty much got it wrong in the June SEP, and now where do they go for going into next year? And then how does that square with whatever monetary policy decision they make?
Yeah, putting together the December summary of economic projections might be challenging. Megan, thank you. It's good to hear from you. As always, thank you very much. Megan Robson there of BNP Paribas. Equity futures on the S&P, just a bit softer, down 0.1%. With an update on stories elsewhere, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. BMW took over 2 years to discover the extent of a braking system fault. A recall document seen by Bloomberg shows that customers and dealers began complaining about the faulty brakes in June of 2022. But it wasn't until October of last year that an in-depth review was launched. The fix is expected to cost the car maker over $1 billion. TikTok is taking its fight against a U.S. ban to the next level. The U.S. Court of Appeals for the D.C. Circuit will hear arguments against a new law signed by President Biden, which bans a social media app unless its Beijing parent company ByteDance sells it. ByteDance, TikTok, and a group of its users will argue to a 3-judge panel that the law violates the Constitution's First Amendment. And the history-making Polaris Dawn crew is back on Earth. The SpaceX capsule splashed down off the coast of Florida early Sunday morning after gliding to the ocean under 4 parachutes. The highlight of the mission was the first commercial spacewalk conducted by billionaire Jarek Isaacman and SpaceX engineer Sarah Gillis on Thursday. And that's your brief, John.
Danny, thank you. Thanks for this morning. Just phenomenal stuff at SpaceX. Congratulations to everyone over there and the whole of the team. Equity futures right now slightly negative on the S&P as we count you down to the opening bell. Up next on our program, we'll set you up for the week ahead and catch up with Bloomberg's Ira Jersey about how this market is priced going into Wednesday.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
.38 minutes away from the opening bell on a 5-day winning streak on the S&P 500, and equities pulling back 0.1%. Equity futures just a little bit softer. Bond market stable, 365 on 10s. And in the FX market, the dollar near the weakest level of the year to kick off a week, with euro dollar at 111 and dollar yen around 140. Let's get to the calendar. The trading diary for the week ahead looks like this. Tomorrow, retail sales and the Fed kicking off its 2-day meeting. Wednesday, a Federal Reserve decision followed by a news conference with Chairman Powell on Thursday. Another round of jobless claims plus a rate decision from the BOE. Then on Friday, it's the Bank of Japan's turn.
not validate the pricing, and you could see, January Fed funds futures sell off a little bit. Importantly for the longer end of the curve and for what the shape of the yield curve will ultimately do, the end of 2025 dots will probably be far more important to the price of the Bloomberg Treasury Index, because the market tends to focus on not what's coming up near term, but what the Fed thinks it's going to do, and therefore what the market expects the Fed is going to do over the next 15 to 18 months. So that 2025 dot will be very important, and especially if they move that lower as well from the current very modest cuts that are expected in 2025. If those extend, then you can wind up seeing even a more broad rally in the Treasury market.
Ira, when it comes to this debate of 25 or 50, do you think politics has any impact at all?
Probably not. I mean, in the back of their minds, I think it has to. Certainly, the policy implications of having one candidate or the other will be, has to be there. So if you have more protectionist policies that potentially make goods prices go up in the U.S., that does have a policy implication. But overall, the Fed has to look at what does the incoming data show. Are we worried more about inflation or more worried about the jobs? And right now, they've made it very clear that jobs is their primary concern right now. And that's a major shift, obviously, from where we were a year and a half ago, where they didn't care at all about the job market. It was all about inflation and only inflation. So I suspect that that's something that's going to, that politics matters, but not that much.
Ira Jersey of Bloomberg Intelligence. Ira, thank you, sir. Particularly after that Jackson Hole address from Chairman Powell, it felt like this central bank was a single-issue central bank, but this time the issues changed. It was no longer about inflation. It was now just about the jobs market. Jobless claims come on Thursday. Tomorrow morning, we get retail sales, the big one, sandwiched in between. The Federal Reserve just around the corner. Our lineup tomorrow, Greg Davis of Vanguard, Katie Kaminsky of Alpha Simplex, Blarina Urucci of T. Rowe Price, and Ashok Bhatia of Neuberger Berman. The good news is we're getting closer and closer to actually getting a decision and settling the debate. 25 or 50. From New York, this was Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness. About artificial intelligence. Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that, other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Markets start the week subdued. 30 minutes until the start of cash trading. I'm Matt Miller.
I'm Shonali Bassett. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
We are kind of chilled out right now, but there's so much going on this week. Central bank decisions, traders divided on how big a rate cut the Fed will deliver on Wednesday. The S&P 500 has mostly bounced back from its summer sell-off, but the recovery isn't being led by big tech. Instead, it's everyone else's turn. And an apparent assassination attempt on Donald Trump foiled. We've got the latest on another shocking development in the chaotic 2024 race. And let's take a look at where markets are trading right now, because if you just look at the futures, you'll see not a lot of action here. S&P futures pretty much unchanged. NASDAQ futures down, and the 10-year yield holding steady at 364, 365. But we did have the yen with a 130 handle for the first time since 2023. So the dollar weakening against a strengthening yen ahead of the Fed decision to come on Wednesday.
Let's look under the hood here for a few movers, shall we? We can take a look at Apple, down about 2.5% pre-market. A new analyst report notes that based on this first weekend pre-order analysis, demand for the iPhone 16 Pro series is lower than expected. And of course, you have some weakness there in big tech. But Intel, on the other side here, up 2.5% pre-market. The chipmaker officially qualified for as much as $3.5 billion in federal grants to make semiconductors for the Pentagon, according to people familiar with the matter. Some good news finally for Intel, Matt.
Yeah, if they don't have any customers, we'll give them customers. It's a big week for central banks as investors prepare for the Fed to cut rates. The BOE and the BOJ also decide on policy. Take a look at this mega wall. We're expecting the Fed to cut either 25 or 50 basis points. Right now, the pricing is... the majority of bets from traders are for 50 basis point cut, and Bill Dudley is out with the piece on the Bloomberg terminal this morning arguing for it as well. The BOE and the BOJ on hold, but I think it's more likely we get a 25 basis point cut, considering that of all the major banks on Wall Street that you cover so closely, only one, JP Morgan, is arguing for 50 basis points.
It's fascinating. Bill Dudley, another prominent voice, arguing for that 50 basis point rate cut as well. But what signal would that send to the market? Another thing, we've been watching that carry trade. It would be more stable if the Bank of Japan holds stable and we only get that 25 basis point rate cut. Let's see where the week brings us.
That's a good point. That's something that Dudley didn't mention, because he outlined the cases for both, and he didn't mention the carry trade. I think is really an interesting argument, Shonali. Bloomberg spoke to PIMCO's CEO, Manny Roman, to discuss his thoughts on the upcoming Fed decision.
We're in the camp of 25, but I always say we have a crystal ball, and at the end of the day, we'll see what the market does. It may very well be that it doesn't make that much of a difference. There will be 3 cuts of 25, and at the end of the day, what matters is where we are at the end of the year. The total sum of the rate cuts may matter more than how they do it.
Joining us now is Amanda Agati, CIO for Asset Management Group, the Asset Management Group at PNC. And Amanda, I mean, what's your take? It's essentially a toss-up right now. Do we get 50 or 25?
Well, it's always nice to be with you. Thanks so much for having me. We're in that 25 basis point camp as well. We really think that going 50 basis points this week sends the wrong signal that perhaps we're too late to this party, or maybe the party's ending too abruptly. And so we think 25 is the right first step. And I think we're mostly in lockstep with the consensus view that the ultimate destination is what matters. It's not one 25 basis point rate cut or another. It's the sum total of what we expect to see well into 2025.
It's interesting that our argument about 50 being too much for the market, really, the tough signal about slowing growth. But it's also hard, Amanda, to think about whether they cut 50 basis points and there's an adverse reaction. We were talking about some of the reasons there might be one, but do you really think that that's how it would play out?
Well, it's sort of interesting to see how futures markets are moving. I always describe the market as sort of a kid in candy store, craving the sugar high for more policy accommodation. So the market wants what the market wants. It doesn't necessarily know what's good for it. And so I do think there'll be a little bit of noise and volatility if we get 25 as the market's really starting to move towards wanting 50. But I think 50 signals that something bigger and more fundamental may be breaking down in the backdrop, and the data just doesn't support that, at least not what we're seeing.
Yeah, I mean, we're already seeing stocks near record highs, Amanda. The economy growing at 2.5%, 3%, unemployment at 4.2%. Does it really look bad? I mean, aren't we on track for a soft landing?
Yeah, it's not too shabby, is it? We're still very much in the soft landing camp as well. I think when you look at the data up until the last few months, it's all effectively come in a bit stronger and surprisingly so than expected. And so that's the good news. We don't see the sky falling. We don't see, standing at the edge of a recessionary cliff here. But there are some cracks that are starting to form, and certainly the labor market is showing a few signs of weakness. So we absolutely think it's right for the Fed to start cutting here and recalibrate, even if for no other reason than where real yields have moved to. There's some recalibration that needs to happen here to reset financial conditions. But we think if they start now and kind of keep chipping away at it, that elusive soft landing may be engineered after all.
I also want to acknowledge the swarm of central bank decisions that we really have this week and recognize that even though that the Fed's decision here is what U.S. investors are watching so very closely, how much volatility could there be around the other rate decisions? If you think about the carry trade and the linkages, for example, there have been between Japan and the United States, do you think that investors should be expecting some strange movements this week?
I think so, absolutely. I've been saying hashtag choppy is the word for the second half here. And based on how things played out at the beginning of August and the carry trade influence there in terms of the market downdraft, investors should be paying close attention to what happens with the BOJ. I think what's also sort of interesting is the central bank moves are a little bit out of whack. That's maybe a technical term for you relative to history. We don't usually see the Fed a little bit behind others in terms of taking the step. They're usually the leader. So it's important for the Fed to take action this week. But I think the BOJ hopefully has learned a little bit of lesson from what happened the last time around, but we'll see. It'll be an interesting meeting to see how they handle things.
So what do you buy after, assuming we get a cut, Amanda, I imagine the market will be happy about that, or is it buy the rumor, sell the news in the case of a 25 basis point cut?
It feels a little bit like a snoozer. That's my term for it, that the market has already kind of moved to anticipate some of these policy actions. And with valuation sitting at near price to perfection levels and the earnings growth backdrop starting to slow pretty materially, at least just for Q3 expectations, I don't know that there's a table pounding opportunity at the moment. We're still very focused on diversified exposures across equities in terms of capitalization and style and really leaning into quality. I think it's still the name of the game here, despite what happens.
But what about, we have a story on the Bloomberg terminal about a rotation in terms of earnings. The 493 are catching up to the Mag 7, and it looks like that's what the market was doing as well. On the other hand, we're going to talk to Natalia a little bit later, is going to tell us that everyone's buying Mag 7 stocks now. Who benefits the most over the medium term if you get cuts coming from the Fed?
Oh, the bottom 493 for sure. Yeah. But I think this first rate cut doesn't mean all that much for small and mid. And that's been where a ton of pressure actually has been in terms of equity capitalization. And so a few more rate cuts under our belt here, and I think it actually makes a world of difference for small and mid. So I'm interested in quality as it relates to the large cap and the S&P 500 exposure there, but I'm a lot more interested in picking up some opportunities in small and mid. It just feels a little bit early to back up the truck there.
Speaking of backing up the truck, you have BlackRock warning on the bond market, saying that the rate cut bets are overdone. And we have to recognize that there's still so much uncertainty for what may come this week, let alone what may come for the next 6 to 12 months. Amanda, do you have any underlying concerns at this moment about the direction of inflation, particularly heading into and out of the election at this point?
I don't have any particular concerns at the moment. I think in general, it seems like we're starting to get that inflation battle a bit more under control. I don't know that we're particularly out of the woods yet. If you look at the services side of the equation, it's still running pretty hot. But on balance, it feels like we're getting to a more tame place. But that's why I think I'm a little hesitant to say, oh, we should go 50 right out of the gate here this week and another 50 on top of that, which is what the market is thinking. I think going too aggressively right out of the gate may catalyze a little bit of additional inflationary fire that we really don't want at this stage of the cycle.
Amanda, great having you on the program. Thanks very much for joining us. PNC's Amanda Agati talking to us to kick off the week, a week in which we'll get a Fed decision, the first rate cuts that we've had in years. Get a check on futures right now. For that, we get over to, well, the boards here. S&P futures unchanged, as you saw earlier. NASDAQ futures down 0.5%. And Russell 2000 futures, this rotation looks to be happening at least early on a Monday morning, gaining here. In terms of the stocks moving ahead of the opening bell, the individual names in the pre-market, let's get over to Abigail Doolittle. Abby?
Well, we do have Apple down sharply here, down 2.5% after last week's big rally. That has to do with this cooling of risk sentiment that we're seeing today. In part, we're seeing it also for the shares of NVIDIA after a 16% gain last week. That stock now down in the pre-market as well, back below its 50-day moving average. So folks rethinking the buy the dip of the big tech names. Turning to the shares of Clorox, we are going to see that they are lower. This after a massive, Colgate-Palmolive, after a massive rally over the last year, more than 40% higher, having to do with big growth. Well, Wells Fargo today cutting these shares to underperform from equal weight. That's essentially a sell rating, saying that the epic run, the growth, well, it's priced in. Investors taking that seriously with the stock down 1.5%. And then finally, DJT, Trump Media and Technology up 1.1%. This after a big gain last week after Donald Trump says he will not be selling shares. In addition, we had that apparent assassination attempt over the weekend. The last time that happened in July, the shares rallied in a big way. Today, a modest rally after, again, last week's gain. Sonali.
Abigail, thank you so very much. Now coming up, former President Trump is safe after a second assassination attempt in 2 months. More on that next. This is Bloomberg.
People, I think, from Homeland Security and or the CIA or NSA have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation the intentional communication of false statements. And TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
Wednesday, the Fed decides.
I know we're all obsessed about what the Fed may or may not do on September 18th.
25.50, that doesn't matter so much.
We're being very measured where maybe other central banks aren't.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We have made no decisions about future meetings, and that includes the September meeting.
At this point, the Fed is leaving it open.
It's going to be up to Chairman Powell.
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
Getting out of high interest to look at what's making headlines around the world. Disney's Shogun claimed the top prize at the Emmys last night. The show picked up the Best Drama Award, the first time Disney won it in 19 years. The adaptation of a 1975 novel is the first series in a language other than English to claim the award. It also shattered the record for most wins by a show in a single year, achieving 18 across the Primetime Emmys and the Creative Arts Awards. Meanwhile, Apollo agreed to a $1 billion pipeline purchase. Let's get back to that story. For a non-controlling stake in a key Caspian region natural gas pipeline. The move will help the energy major relocate some of its resources amid a slump in crude prices, while the upside for Apollo is access to a key gas project. And the race for the White House saw another dramatic development yesterday after members of the Secret Service engaged what law enforcement described as a rifle-wielding potential assassin near former President Donald Trump on Sunday. An eruption of gunfire at the Palm Beach course ensued before a 58-year-old suspect was detained by law enforcement.
And joining us now with more is Jack Fitzpatrick of Bloomberg Government. And let's talk about not only the events of this weekend, but also the response, particularly the congressional response and fallout for how to handle what happened.
Well, there's going to be a significant congressional response. There already was congressional scrutiny of the Secret Service after the failed assassination attempt in July. There's a bipartisan House panel that has been focused on that. The Senate also put off its bill to fund the Secret Service as members looked into if the agency needs more resources. Now, the acting director of the Secret Service told them a couple weeks ago the agency was not lacking in resources. It wasn't a lack of resources that led to that near miss in July, but now there's just heightened scrutiny. About 15 minutes ago, Speaker Johnson tweeted that figuring out how there have been multiple assassination attempts on one candidate is going to be a top priority. And President Biden just told reporters he thinks the Secret Service may need more resources. So it's an agency that has said they should have what they need to do their jobs in the near term, but they may be under some pressure to come up with a better plan to better protect candidates in the near future.
I still see, Jack, I look at WSL election on the Bloomberg terminal at least a few times every day, and I still see, in terms of the betting markets, Kamala Harris 57%, Donald Trump 46%. He didn't get the same boost with this alleged attempted assassination that he did last time when we actually saw bullets flying. Do you expect the campaign to get a bump throughout the week?
It's really hard to say, especially looking back at the July attempted assassination. That was such a major event in American politics. And then, the spotlight was on that for about a week before President Biden announced that he was stepping aside as the Democratic nominee. The main story after that was the momentum that Kamala Harris had quickly gotten going. So this has been such a chaotic presidential election and campaign season that while this is a very major event that's putting a spotlight on Trump, it's very hard to figure out what everybody's going to be talking about a couple weeks from now. So for now, we know it's a close race. All the polling shows it's a close race. Any one major event can make a difference, but it's very hard to predict what the dominant narrative is going to be very far into the future.
You think about Kamala Harris's response here, the vice president's response: violence has no place in America. This is the second assassination attempt in 2 months. And at the end of the day, when you think about how we head toward the election and the unity that both tickets, let's say, had been trying to at least initially run on, do you think that unity lasts until November? What's the risk here that this creates more division in this?
Well, there's been somewhat of an attempt at unity even before this, and it's true. Kamala Harris, President Biden, a bipartisan group of members of Congress have said there's no place for violence. You've heard the kind of statements you would hope to hear from political leaders in the wake of this. You also, incidentally, actually had a handshake between the two candidates at the debate last week and at an event on September 11th after a bit of a lack of handshakes recently among candidates when Trump is involved. So there are some attempts at what you would normally call the normal means of comity in American politics, but it's a bit of an uphill battle given the way the rhetoric has been recently. So it's some moderately good news on the intensity of the rhetoric recently.
For us, Jack, of course, Bloomberg is focused on kind of the intersection between Washington and Wall Street, as are you and I. And Scott Cronert out at Citi has led a group of strategists in trying to figure out what each candidate's economic policies would mean for the stock market. They figure Kamala Harris's policies with her increase in taxes across many categories would hurt the fair value of the stock market by 4 to 6%, whereas Trump's would hurt the fair value of the stock market between 0 and 4%. So it looks like, as usual, stock market commentators are saying that the Democrats would be worse for prices than Republicans.
Yeah, and that's a broad view of it that largely matches what you would at least vaguely understand from their fiscal policies. Harris's proposals on the tax front involve some proposed increase on the top earners, more along the lines of what you've heard from President Biden. There is sort of a countervailing concern, though, about the amount that a Trump administration could add to the federal debt. So one way of looking at it is what that means for the stock market. There are also concerns about the long-term sustainability of these fiscal proposals. Really, there are still some specifics to be hashed out for what both candidates would prioritize on taxes. But we do know that there are tax deadlines coming up, and the next president will have a major focus on tax policy early in their administration.
Jack, great to get some time with you. Thanks so much for joining us. Jack Fitzpatrick there of Bloomberg Government. For the latest developments on the U.S. elections, you can type ELEC GO, E-L-E-C GO, on your Bloomberg terminal. Coming up, Intel could be supplying chips for the U.S. military. So they finally found a really good customer. We'll have details next. In Social Climbers, this is Bloomberg. I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
DOJ or other authorities
Could face bigger challenges.
It was going to keep reading World Cup. This is a three.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
And it's time now for social climbers. The companies making waves this morning. First up, Disney and DirecTV are calling a truce. The company's announcing that a new deal that will restore ESPN, ABC, FX, and the Disney Channel to DirecTV lineup after a nearly 2-week blackout. The deal was reached just a day ahead of a full day of college football over the weekend and on the eve of the Emmy Awards on Sunday. And next, Intel has officially qualified for as much as $3.5 billion in federal grants to make chips for the Pentagon. Intel has always been the front runner for this award, but there's been pushback from other chip makers, as well as concerns in Washington about relying on one firm. The funding could be announced as soon as next week. Finally, Exact Sciences announcing today that a blood-based test that it's developing showed promise in accurately detecting colon cancer. The company said its test detected 88.3% of cancers. And you can follow all the latest company buzz on TREN Go on your Bloomberg terminal, Matt.
All right, let's get a quick check on what's going on in the markets to kick off this trading week. Of course, we do have the Fed decision coming out on Wednesday. We've seen not a lot of movement in terms of S&P futures. Right now, you can see that they're down just 0.07%. NASDAQ futures are off 0.5%. And Russell 2000 futures, the small caps, are gaining. It's interesting, though, if you look under the hood, and a lot of individual movers to talk about today, and really questions about where people are buying. Are they buying the Mag 7 stocks or not? Coming up, we're going to speak with Jason Trennert of Strategas on why he thinks inflationary pressures will remain well into the future. That could hold the Fed back. This is Bloomberg.
In this facility, which is part of your $2 billion investment in the last 2 years, it's a massive amount.
Yes, because, we've focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99%. of talent that we've trained overseas and in India. We have our own internal skill building center where we train on site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that, not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We got just 20 seconds until the cash trade, and futures are showing not a lot going on in terms of S&P stocks. NASDAQ futures are down about 0.5%. Looks like we have some gains in small caps. So maybe you do see more of a rotation today. We had a story out on the terminal saying that the S&P 493 have really caught up in terms of posting earnings, while investors have shied away from the Mag 7. On the other hand, we do see a lot of positioning from hedge funds in the Mag 7. We'll talk about that later on in the program. There you hear the bell, K-Force ringing it down the New York Stock Exchange. You see, in terms of the cash trade, it takes a couple seconds for things to really get started, but this is still a futures picture. We are close. We are near as can be to an all-time record, right? 56.67 is the record on the S&P, and we're just less than 40 points away from that on the Friday close. Let's get over to Shanali with some of the first trades. Intel is one of them. Shanali, you want to take that over?
Yeah, sure. Let's take it over. Let's talk about Intel because, of course, we have seen Intel on the rise this morning because the chipmaker has officially qualified for as much as $3.5 billion in federal grants to make semiconductors for the Pentagon. That's according to people familiar with the matter, but you only see Intel up about 0.8%. Really, it was up higher pre-market. We'll keep an eye on that through the trade. Keeping an eye also on Trump Media and Technology. This is the ticker DJT. Donald Trump said that he has absolutely no intention of selling his stake. When a lockup period expires later this week, you are seeing DJT up about 1.5% as the market opens. And Apple, an analyst report notes that based on the first weekend pre-order analysis that was made, demand for the iPhone 16 Pro series is lower than expected. You see Apple shares down at the open almost 3%. Let's take a look with Abigail Doolittle.
Yeah, that's right, Shanali. And on the year, we do have Apple trading higher up about 12%. It's interesting because it hasn't been a smooth ride. Initially, the stock had been down more than 10%, then up 40%, down about 6% from that high. Overall, there's a bit of a topping area there, a concern given the fact that we do have this analyst over at TF International Securities saying that the iPhone 16 first pre-weekend pre-order sales estimated at about 37 million units, down nearly 13% on a year-over-year basis, that from last year's iPhone 15. So that's not what folks were expecting at all. So there is, of course, that intense competition with Chinese makers. Let's take a look at the importance of the iPhone to Apple, just in case you didn't know, but we can look at it more specifically. I think everybody does associate the iPhone most with Apple, but they, of course, have lots of other businesses going on, services, which they've been trying to build up about 24% of the pie, and then a myriad of other businesses. But take a look, Matt, there at that iPhone, 52%, and they want that strength. There was a lot of hype going into the release of this phone saying it was going to be the next great thing that everybody was going to buy. Well, apparently the first weekend really not showing that.
But did you buy one, Abigail?
I don't, because right now I have an iPhone 14 Pro and an iPhone 15, so I'm set right now.
A couple. All right. Well, yeah, I guess that's good enough. Abigail Doolittle, thanks very much for that. Let's talk about what's going on in this market, in this economy, ahead of, obviously, the big Fed meeting on Wednesday. The debate right now, is it 50 or is it 25? But there are real issues, obviously, underlining that decision. Joining us is Jason Trenner, chairman at Strategas Research Partners. Jason, great to have you on the program. Thanks so much for joining us.
Thanks for having me. I appreciate it.
What do you think about, it seems like this Fed typically likes to telegraph things before they unleash them on the market. So even if there are arguments for 50 basis points, Bill Dudley is out this morning saying that, the labor market is the biggest argument for that. What is your expectation for the actual cut?
My best guess is that it's going to be 50. I don't necessarily believe that's the right move, but I do think it's likely to be 50, and that's because I'm getting the inclination that Chairman Powell wants 50.
They're telegraphing it to you.
Well, not necessarily, but I think, there could be a difference between the committee and the chairman, but I've been told from people that are very familiar with this and have been on the Fed that it's not a democracy. There could be dissents, there could be other things, but largely it's the chairman's decision.
Why 50? What is the case for 50?
The strongest case for 50 is that you are at your maximum difference between the Fed funds rate and the inflation rate. Right, so this is your least chance of making a mistake if you go big, because you're at the very beginning of the easing cycle, right? So the real Fed funds rate is as high, hopefully, as it's going to be. So that's the strongest argument, I would say. I have concerns about another wave of inflation. I think there are structural reasons why another wave of inflation is possible, if not likely, in the future. So I would kind of argue for going more slowly, but my opinion doesn't make any difference. I do think the stock market will be disappointed if it doesn't get 50. I think it will be elated if it does get 50. And so we'll see. And then the statement will also have a big impact, right? The forward guidance that you get from the statement will also be important.
The other question I have that is probably lesser looked at this week because of the Fed press conference coming up is the fact that the House Republicans are searching for a plan to avert a government shutdown in 15 days. Do you think that the fiscal issues that this country is facing is baked into a risk premium here in the bond market? Is some of this not about the economy itself and about kind of the state of our country?
Chanel, it's a great question. My own opinion, and this is just from dealing with institutional investors all day long, every day, is that very few people are talking about the government shutdown, and I don't think the fiscal issues are clearly that big an issue because we have $35 trillion in debt total. So people are just kind of made their peace with it, that we have the reserve currency and therefore we can get away with murder financially, right? So at a certain point, though, I do think the bill will come due. There is a limit to what you can do, and that will largely be, in my opinion, exhibited in the bond market at some point. But right now, I don't think it's in there.
Is there any? You mentioned your concern about inflation. I think it's very interesting. Mark Zandi at Moody's said that the rate cut would go a long way to take the Fed's boot off the neck of the economy. I thought it was a great way to put it. But don't you want to keep it there if you're worried about inflation?
Yeah, listen, I think I would with Mark, and I don't know him personally, but I would just say, listen, if you look at financial conditions are pretty easy, right? Corporate credit spreads are tight. We're within less than 1% from the highs in the S&P 500. The unemployment rate's 4.2%, which is probably too young, but when I was coming out of college, that was considered like more than full employment. So I'm not so sure what the rush.
They want sustainable maximum employment, right? So 3.4 is not sustainable, right?
Right, precisely. So I think, in my opinion, I would kind of go more slowly. And the structural issues I'm talking about are an end to globalization. I think that's a biggie. I do think that the deficits that we have right now, which are about 7% of GDP, not sustainable. There's no coordination between fiscal and monetary policy. And so these
the IRA, the CHIPS Act.
Right, you have all of these things. It's very, very difficult to get control of inflation over the longer term if there's no coordination.
Bigger problem that I see actually is what you call the common man CPI.
Right.
You have written to us that what you track, and this is the things that you would buy as any American: food, shelter, energy, children's clothing, that has been outpacing the headline number.
Right.
Daycare, dog care, for that matter, right?
Okay, right.
So if that is the case, then how could it also be the case that we're okay with the state of inflation today, that we're ready to cut 50 basis points?
Listen, I think, again, there's two, obviously the Fed has two mandates, right, which is full employment and inflation. If you're looking at from the employment picture, you're up from 3.4 to 4.2%. If you use the SOM rule, you'd say, a recession is imminent.
Many economists think barreling towards 5%.
Right, so so that could be a rationale. But I do think, my own opinion, talking about the common man CPI, we just use the things in the CPI that people have to buy every day. So it's food, energy, shelter, children's clothing, insurance, and utilities. And so what you've noticed there, when we look at that, that's outpaced the headline inflation number in 38 of the last 43 months. And it's growing faster than wages. So that's part of the reason why I think people are so grumpy. And I can understand the Biden administration's, several months ago, they were saying, like, why aren't we getting more credit on the economy? Because the stock market's high and the unemployment rate's relatively low. The reason why they're not getting more credit is that for the average person, their standard of living has deteriorated over the past 3.5 years. Their purchasing power has weakened. And so that's why people are grumpy, despite the fact that it might look good on the outside. And that's why I think inflation will remain, I think it will be one of the, if not the biggest issue in the election in 7 weeks, among the top 2 issues in the election.
Perhaps one of the biggest issues coming out. Jason, we thank you so much for joining us today.
Thank you.
Jason.
We're gonna stick with him. So we're gonna keep talking to him after this break.
No, we actually have a new guest coming up. A surprise for you, Matthew. But hang tight. We will have Jason back on this program soon. That is for sure. That is Jason Trennard of Strategas Research Partners. Thank you. Now, coming up, former New York Fed President Bill Dudley, the man who's been calling for 50, says the Fed should go big now, and he thinks that it will. We're going to talk to him next on why. This is Bloomberg.
I see.
In tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Former New York Fed President Bill Dudley says the case for an aggressive cut when the Fed meets this week makes sense. In a Bloomberg opinion column out today, he writes that the logic supporting a 50 basis point cut is compelling and that the downside risks to employment outweigh upside risks to inflation. And we are now joined by Bill Dudley. And if you think about the days ahead, if you think about that case for 50 and why we're still standing here days before on a razor's edge, why is it that the expectations seem to be changing so quickly, not only for the market, but even inside the Fed?
I think what happened was last week we got two articles, one in the Wall Street Journal and the other in the Financial Times, that basically said the issue of 25 versus 50 basis points is open. And basically the people in those articles, including myself and one of them, basically made the case that the logic for 50 basis points was pretty compelling. And I think as people have reflected on that, and the Fed hasn't pushed back against the change in expectations, the market has come to the view that 50 basis points at this meeting is in fact appropriate. I think what happened was that Powell, thought about it a little bit more and decided that the deterioration that we've seen in the labor market over the last few months means that the downside risks of the labor market probably outweigh the upside risks to inflation at a time that monetary policy is tight. So it's pretty important that the Fed head back to neutral expeditiously, and that 25 basis points wasn't fast enough.
I was fascinated by your column and the point you make about maximum sustainable unemployment. I always hear maximum employment, and it's great to see the sustainable in there because it seems to me 4.2% is a lot more sustainable than 3.4%. Do you really want to push back towards those incredible lows?
No, I don't think so. I mean, I think the Fed in their summary of economic projections, we'll get a new set this week, basically thinks that full employment is around 4%. By that, I mean, at 4% unemployment, you're not going to get upward pressure on inflation or downward pressure on inflation. You can just sit there. So right now we're running at an unemployment rate a little bit above that, which just reinforces the Fed's view that the downward pressure on inflation is going to persist.
Why, Bill, are you not more concerned about inflation itself? With the November election just around the corner as well, and two presidents that may introduce policies that could be inflationary, why would 50 be the right thing to do now with the labor market in sight and lesser worries here about the reacceleration or at least sticky inflation?
I think it's because the Fed takes the world as it is and doesn't speculate about what's going to happen in the future, or who's going to win the election, what policies set they're actually going to get. That's going to take, quite a few months to play out. I mean, the new president won't be coming in until late January. So I think the Fed's view is we got to set policy based on what we see today, what we see on the risks of inflation versus the labor market. And, if the policies that are pursued by the next president turn out to be inflationary, then the Fed will adjust policy appropriately at that time.
In terms of the terminal rate, and you mentioned in your column that it's far more important than how we get there. What do you see? Because neutral is what, 3%? Is it 2.5 or 3.5?
There's a lot of arguments about where neutral is. I think all we can say is it's well below where we are today. The Federal Reserve's central tendency for neutral is 2.8% federal funds rate at 2% inflation. I would probably have a little bit higher rate than that, more like 3.5%. But 3.5% federal funds rate is still far below where we are today, nearly 200 basis points below where we are today. So the point is there's a long way to go, even if you don't know precisely where neutral is. And so it makes sense to start heading in that direction.
Bill, given the concerns about the labor market, perhaps you can draw out what the world looks like, what the United States looks like if we only go 25, if they take a more conservative stance in cutting here. What does the labor market look like?
Well, it's probably not a disaster, right? Because the market's anticipating, a lot of rate cuts over the months and years ahead. So the fact that they get there a little bit more slowly is not a disaster. But why would you want to take more risk on the labor market at a time that the labor market's already shown some deterioration? The sovereign rule basically tells you that when the labor market deteriorates up beyond a certain point, the risk is that it becomes self-reinforcing, and then you have a full-blown recession. So waiting increases that risk, not dramatically, but a little bit. And the question at this point is why would you want to take that risk?
It does seem like you're kind of dovetailing Claudia Sahm and Malcolm Gladwell in your column today on the Terminal. You talk about the tipping point when unemployment, I should say, starts to accelerate, then it really turns down. Is it possible to turn that kind of thing around with rate cuts once it's already started? Is it too late?
Well, that's the whole problem, is that when people hear about the labor market deteriorating, then they start to pull back on their spending. When they pull back on their spending, that means that at least some more layoffs and the whole process becomes self-reinforcing. The good news, though, is that monetary policy, I think, still has long and variable lags, but they're not as long and variable as they used to be because the market anticipates what the Fed's going to do before the Federal Reserve actually does it. So, for example, look at two-year Treasury yields today, way lower than the federal funds rate. So the market's already putting in place easier financial conditions, and that will help support the economy and reduce that risk of recession.
Just incredible. There was almost a 50 basis point move over the past month in the 2-year alone. But you look at the market, and to the point that you've been making about that series of cuts expected over the next year, and the market is still right now anticipating 120 basis points nearly worth of rate cuts this year. Do you think that there's some reason behind that makes sense to you? And what do you think that the Federal Reserve needs to communicate Wednesday about the path forward?
Well, I think what Powell's going to do in the press conference is going to try to calm everyone down, that the 50 basis point rate cut is not because of tremendous alarm about the economy. It's just that we've accomplished our mission of becoming highly confident we're going to get inflation down to 2%. And so the dual mandate objectives are now balanced. And so it's time to head back to neutral. So I think he's going to try to do it in a very low key, non-alarming way. And I think he can make that case pretty well.
But 50 basis points in itself is kind of alarming, considering this is a Fed that's so conservative. They always seem to telegraph every move they make. The market knows about it weeks, if not months before, unless they leak to the Wall Street Journal. Isn't that going to be a problematic sign?
Well, I don't think they communicated this as well as we would like. I mean, people shouldn't be trying to get their information by reading the tea leaves in the Wall Street Journal or the Financial Times. But I think it's partly because the situation changed. The last employment report was not weak for the current month, but there were significant downward revisions to payroll employment for the prior 2 months, so that the 3-month change in payroll employment now is the weakest it's been since 2020. And I think that got the Fed's attention. And I think more and more people sort of made the case that I made. If you really believe that dual mandate objectives are balanced, then policy should be at neutral. So let's get going. Remember, the Fed was really late on the way up. And I think they remember that, and now they don't want to be real late on the way down.
Bill, great to have you on the program. Thanks so much for joining us. Bill Dudley there, former New York Fed president. He is also a Bloomberg opinion columnist, and you can check out his story on the Terminal today. Coming up, hedge fund Eisler Capital seeing a fresh round of departures. Wall Street Beat coming up next. We'll tell you who's leaving and who's left. This is Bloomberg.
your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
This is Bloomberg Open Interest. Get a quick check on stocks. 23 minutes into the session, and we're still seeing a whole lot of nothing on the S&P 500. That may be because investors are selling the Mag 7 and buying the 493. At least it's one columnist on the Bloomberg Terminal argued. The NASDAQ 100 as evidence for that, down 0.6%. The Russell 2000 moving up about 0.2%.
Fascinating, though. This is after a 5-day rally in those Mag 7 stocks, so maybe some cooling, right? Anyways, time now for the Wall Street Beat. 10 money managers have left Eisler Capital in recent days. The $4 billion hedge fund is facing a period of poor returns and an intense talent war while it tries to transform into a multi-strategy hedge fund. And for more, we're joined by Bloomberg senior hedge fund reporter Nishant Kumar. And you think about what Eisler has been trying to do. Is there a cautionary tale here? Multi-strats have really been, let's say, the only game in town more recently in hedge funds. But if you try to change too fast and not stick to your knittings, Eisler was a very prominent macro fund, for example. Are there going to be issues in that transferal?
Definitely. It's incredibly hard to become a multi-strat. You know, you just can't compete with the top tier people who are getting the best talent. They have the deepest pocket. They have more experienced people who manage those businesses. And they are a brand that people associate with. So any new entrant is bound to face this kind of a problem. People leaving, yes, it looks really big news and odd, but this is the business model. High turnover is the business model of multi-strat funds. No one is immune to that.
So, I mean, put it in perspective for us, Nishant, because to me, at first glance, as someone who isn't as familiar with the industry as you and Shanali, when 10 money managers leave or are dismissed from a hedge fund, it would be a really bad sign. Like if I had my money there, I'd be trying to get it out. Is it normal?
This is very normal, oddly, in the multi-strat world. So all these multi-strats have dozens and dozens and dozens of people. We are talking about more than 100 people, 100 traders here. And we have to think about how they are structured. So you have few individuals who run most of the risk. And then you have a long tail of people who run smaller risk. And that's why those people sometimes get
we got to leave it there. But don't miss Nishant's report on the Bloomberg Terminal, a most read story. Stick with us for the next hour of Open Interest. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
There is this real momentum from Wall Street. We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so check us out there. We have Alex Steele, Paul Sweeney, and we are bringing Bloomberg Intelligence to you here this morning. We're going to check in with Liz McCormick, Bloomberg Chief Correspondent for Global Macro Markets. She's going to give us her thoughts on kind of where she thinks this Fed is going to go, 25 basis points or 50. Mike McGlone, I see him over there in London. Somehow he got out of Miami. He's in the Bloomberg London office. He's going to talk to us about commodities. Hedge funds buying corn? What, are you kidding me? Jim Somoza, Managing Director of Industry City, joins to discuss commercial real estate and how Brooklyn's Industry City is positioned in NYC's real estate market. I didn't even know there was an Industry City in Brooklyn.
Yeah, it is. Oh my God, Industry City is the best.
Is it really?
It is so cool,
Oh, cool.
and so fun and so awesome. Highly recommend.
Very good. We'll find out what that whole thing is. That's what the smart kids are doing there. Speaking of smart kids, let's go to Mr. John Tucker and get a Bloomberg Business Flash.
To turn around and see who you're talking about. Major stock averages, they are mixed right now. 9 of the 11 major industry groups in the S&P 500 are higher. Energy, best performer as crude climbs above $70 a barrel. Traders now see a 50 basis point September Fed rate cut likelier than 25 basis points. Of course, the meeting and the decision starts tomorrow. The decision follows a day later. Bloomberg opinion columnist, former New York Fed President Bill Dudley says that is the right call.
Doing 25 would have been awkward because it would have disappointed market expectations. They probably would have shown only another 50 basis points in their summary projections. So the Fed would be essentially saying we're only going to do 75 basis points this year when the market was priced for about 120. So I think doing 50 brings the Fed more in alignment with the market, and it also fits the logic of the moment.
Bill Dudley, the former Fed president and current Bloomberg columnist. Of course, the Fed decision comes Wednesday after what appears to be that second attempt on his life. And after he said he would not be selling shares, Trump media is on the move today. Those shares, they are down another 2.5%. Shares of Intel on the move after word of a deal with the U.S. military. The shares of Intel this morning, they are up 4.1%. And some new doubts raised about the latest iPhone model. As a result, shares of Apple, they are also in focus today, down close to about 3%. And here's one for you. Harlan and Wolff, you know who that is? The British holding company for the shipyard that built the Titanic, going into administration similar to U.S. bankruptcy.
I'm going over to Ireland next week. I'm going to see where the
You're going to go up to Belfast?
Yes, I am.
I've been to Belfast.
So cool.
There's some nice, really nice neighborhoods there, and then there's Fells Road back in the day.
That's where I'm going.
Well, that's not the nicest, but anyway.
gotta
S&P 500 down 2 points. The Dow Jones Industrial Average up 239 points. NASDAQ 100 right now 108 points lower. Brent crude, this is the international benchmark, up 1.8%, 72.96 a barrel. 2-year yield down a basis point at 356. We check the markets for you all day long. Right here on Bloomberg Radio, I'm John Tucker, and that's your Bloomberg Business Flash. Hi, guys.
Hi, nice to be back with you.
It's nice to be back. I forgot how to do this.
Wait, here's the real question, though. So the Apple thing, did you go ahead and buy your iPhone Pro? You ordered your 16
I'm in
Pro.
the queue. Yep.
How many gigabytes?
I don't know. The basic, whatever.
Some stuff. Okay, color?
Black.
Okay, that's not at all boring, but okay.
Anurag told me what to buy, and I bought what Anurag recommended. So
okay,
that's how it
well,
works.
we look forward to the reviews once it is actually delivered. Okay, let's get some more update on the market here. Interactive Brokers Bond Marketplace access their vast selection of over 1 million global fixed income securities with no markup or built-in spreads and low transparent commissions. Learn more at ibkr.com/bonds. All right, let's get to Liz McCormick, Bloomberg Chief Correspondent for global macro markets. Hey, Liz, what is the market price? Okay, actually, better question is, if the market doesn't get what it wants on Wednesday, what is the risk of a reversal within the market?
Well, what I think, Alex, there's a risk on both sides, right? So now the market is just like you guys laid out, touch over 50-50 in favor of 50 bips that the Fed does, but it's a close call, right? So somebody said, either way, half the universe is going to be disappointed, right? So let's go with the 50 folks being disappointed. Say the Fed comes through, which there's many big names still calling for 25, with all due respect to Bill Dudley, and I have a lot. Goldman Sachs was out today sticking with 25, Bank of America. So I think if they go 25, I mean, look at the 2-year yield, 3.5%. It was over 5% in May. It's gone a long way. So I think you're going to get some, I don't think it'll be like nightmare scenario, but I think you're going to get some give back, higher yield if they go 25. But what's making this meeting even more kind of, let's call it angstful, is that we have a lot that's unknown, right? Fed decision, is it 25 or 50? Very rare to have them go into this without the market certain leaning one way. We have always the press conference is key, but we have the update on the dot plot, right? People want to say, hey, well, what are they projecting at the end of next year? Because the market's already got over 200 basis points priced in the next year. So I just think that there's a lot of chances for volatility going into this meeting. And maybe that's stating the obvious, but it's just very heightened.
Liz, how did we get here? I thought when I left for the weekend, I thought we were all in the 25 basis point thing. And then I come in this morning, now everybody's talking about 50 basis points. What happened over the last 4, 5, 6 days?
Yeah, now I'll tell you what technically happened. Now there's a lot of theories on, was there like a little drop of information? But yeah, like you said, it seemed like for sure, 50 was dead. Market went right to 25 after the data, like you mentioned, the CPI. But then there were some news stories in different media that people seem to think, oh, maybe the Fed, because they're in a blackout, they're kind of dropping this because they don't like it and they may go 50. I think, like, let's say we go conservative. Maybe they just wanted some optionality if the Fed did tap these folks. Others say that was just a news story. So we really don't know. But yeah, the market saw that and got like, oh, maybe we're wrong. And people, as you know, are hedging in these markets too and thinking, oh, we better, you know, price in some optionality that they go 50. And then here we are because it continued. Bill Dudley has written a few pieces and he's, of course, a strong voice. And he's, like you said, advocating 50. You know, the other media made it clear that for sure it's not a done deal, that 50 is on the table. It's impossible. So I think that it's just amazing how much, like you said, Paul, it's gone from like if 50 was gone to 50 is back. But like I said, even though we're touch over 50, it's basically like a coin flip, right? So, you know, I think they're going to have a real deliberation, right, at the meeting.
So, Liz, here's the thing, too, is that let's just say they go 25. We're still pricing in for cuts this year about 118 basis points worth of cuts. So if that stays the same, that implies that either the cut in November or December then will be 50. So is it really about the trajectory of this year's rate cuts and the amount that the Fed thinks they're going to get at their dot plots?
Yeah, I think that's really key, Alex, because like you said, if they go 25, but they lay out 100 over the whole 2024, which means, yeah, one of these, we only have November and December. One of them is going to be 50, right? So the market, the dovish folks would take that well, that, okay, it's kind of like some thought Waller, when he spoke the other day, was saying, we could front load them, but I need more data, meaning some people thought we go 25, but they do 50 soon enough, November, December. But yeah, I think the kind of most hawkish for the short term is if they go 25 and they only project 2 more 25 cuts, right? So 75 for the whole year, which is what, you know, Goldman Sachs is saying. I think that would, like you said, when markets priced 118 basis points the whole year, that also bodes for 2-year yields going up in a reaction to that. So that's what I mean. Like, I have my little sheet of the dot plot reminding myself, because not only we will look at the median, we'll look at, okay, how many officials are below the median, above the median? It's that granular right now.
Well, Tom Keene and I on Surveillance earlier this morning interviewed Bill Dudley, and during that interview, Marty from the 5th floor kind of wrote in and says, if the Fed only goes 25 basis points, do you think there will be a dissenting vote? Because Mr. Powell likes to have unanimous votes. Could we get a dissenting vote if they only go 25?
Well, this is where my colleagues like Craig Torres are the experts on this, but I think the sense is that this Fed does not like to have dissent. And this is, Chairman Powell in past pressers has talked about how important, I forget the exact words, that first move is for signaling. I mean, not that it's not possible, but I don't think they would wish for the first move, whatever it is, to come with a dissent on the size. So that's why I think this deliberation is going to be real live. I don't know that that decision is made, even though maybe they wanted the optionality of the market pricing in that. But yeah, Paul, could be possible, but I don't think that's the look this Fed wants on the first inflection point of changing from, you know, holding rates steady to starting to cut them.
All right, Liz, we appreciate it. Thank you for sharing your dot plot little picture there. It wasn't a picture. I mean, there were facts. Liz McCormick, Bloomberg chief correspondent for global macro markets. Truly one of the best. Looking forward to her interpretation of what happens on Wednesday. All right, within the markets, there was some really interesting commodity positioning. And I don't just say that because I'm a commodities nerd, but oil has seen such a strong re-rating. And it's so interesting because hedge funds are net short on oil for the first time since the data started being collected back in 2011. Oil's up by about 2-3% today. Joining us now is Mike McGlone. He is Bloomberg Intelligence Senior Commodity Strategist from London. This is a new background.
I can't believe they took his passport. You got into London. Amazing. After all the lists I put him on?
Way overdue to visit.
Good.
Well, it's good to see you. Let's just start with oil for a second. I mean, at this point, are we so short sort of the market that there's no way we're not going to get some kind of snapback?
I think that's a good response, Alex. The first way you look at it as a commodity trader, yes, it's really Brent that's short 12,000 contracts. It's never been short, and that's most ever, as you mentioned, since 2011. Like WTI is still somewhat long, but I think Brent's more reflective of what everybody sees what's going on with China, excess supply, and the fact that you need OPEC to keep OPEC oil off the market, or market's going to do what it usually does and get cheap, and it's just kind of tilting towards there. But to me, this is indicative of overall commodities, a bearish sentiment. and I think it has good reason. Just look at that 10-year note yield in China, 2.07%, the lowest ever. I mean, compare that to U.S. at 3.66 at the moment. To me, it's just, yeah, you could say a bounce from here, but I think the responsive traders are going to be looking for rallies to sell, which I put for good resistance WTI around 75, and I'm still expecting to do what it has been since 2008, get really cheap, which probably means around $40 a barrel.
One of my favorite indexes is BCOM. Are you guys celebrating a BCOM kind of anniversary or something coming up?
Exactly. Well, I'm glad you mentioned. That's why I'm in London. We have the BCOM Index Advisory Committee. I think I've been going to these for about 20 years, particularly when the BCOM was at S&P and I managed it there. But now it's, again, a better place at Bloomberg. But it's a bit of an anniversary. It's also where everybody gets together and we talk about how to properly manage and rebalance the index.
So
how do you do that?
Yeah.
Well, it's also the methodology, but you have to take advice and counsel from the people who are involved in actually tracking it. I used to actually do that math, but it's very systematic. It's mostly based on, the BCOM is based on total volume, and it's broken up between the three sectors, energy, metals, and agriculture. It keeps them somewhat equal rather than having too much of a weight in energy.
All right, I'm going to go right to one of my favorite commodities, corn. It's up 13% year to date.
I can't
People
eat
aren't
corn.
eating corn.
It's
I
like
love
doing
corn.
You
weird
can't eat
things to
corn?
my-
You don't
Yeah,
eat
it's just-
corn?
I love corn.
Jersey
It's
Shore?
just, you know,
No, you
Jersey,
just
sweet
can't.
Jersey corn.
I can see
weird
that.
things
And like
to me.
soy can be hard to digest,
Oh,
like
please.
some of those guys. Okay.
All right,
I won't go into detail.
All right, give us a smart call on corn here, Mike.
You do, but you don't know it. Corn is the most significant global agricultural commodity in terms of dollar value metric production. That's part of the methodology we'll be talking about on Wednesday. But it's in everything. And actually, it's animal feed, corn syrup, and everything. But the key thing is corn got way too expensive in 2022. Now it's getting towards really cheap. It got down below 4. The last two contracts closed around 380 or so, which is right around U.S. cost of production. And to me, the significance of corn is that's what all commodities are doing. They have to get below that cost of production, have to shut down those excesses of supply, and reinvigorate that demand. And corn's just the lead. It's the most elastic of the commodities because you can bring on that supply in about a year. So to me, that's part of the reason I'm still bearish crude oil. And actually, one of those indicators in middle space was natural gas. Why? Because natural gas is a top form of fertilizer for corn.
Okay, see, it all comes back. What about coffee? So on the flip side, corn's below $4 a barrel, a bushel at one point. Coffee is just crushing to the upside. I mean, Robusta or Arabica, talk to us about it.
Yeah, we don't track it too much. The thing is, significance of coffee and cocoa is they're both born right around, grown, sown right around the equator, and climate change, I think it's directly affecting those commodities, despite things like corn and soybeans and wheat, which are more born in the northern country, potentially in Brazil and U.S., where the weather's still been quite productive for production.
All right, let's go over to the metals here. Copper, up about 10% year to date. What's the call here on copper?
I think the risk is copper goes down, partly because just look at bond yield. So one good way to look at copper, the price of copper on the screen right now is about $4.30 a pound. If you overlay the pounds of copper with the percentage yield of the 10-year note, that's usually where they've been trading almost the last 10 years. So I pointed out China's 10-year notes at 2.07%, U.S. is 3.65. I think copper is just on the cusp of breaking lower with most other commodities. Last few weeks it's been crude oil just kind of catching up to the grains. And the key thing for copper to stay resilient is U.S. stock market has to stay strong. But yet we've priced in so much buy the rumor into the steadies. To me, the risk is sell the fact. And copper, you have to mention in the same sentence as China. China's in a pretty severe deflationary trajectory at the moment.
Yeah, I definitely was reading Citi put out like a quarterly note on commodity outlook, and then for copper, like longer term, they still see that structural shift, energy transition, and all that demand. But then in the near term, you just can't escape sort of the downdraft in China there, and then how you kind of manage that. But there's still broad growth, and like the trough maybe being like 8,000 to 9,000 versus 4,000 to 5,000, which it might have been in different cycles. All right, what else you got? What else are you looking at?
Well, the number one commodity that's going up on the planet, was more the store value, is gold. I got to stick with something in my space that's going up. On a year-to-date. Yeah, well, there you go. On a year-to-date basis, gold's up about 34%. Compare that to the total return of the S&P 500 is 28%. 3 years now, the rock is beating stocks. The risk is it continues. I think it will. And the thing is, you have to just look at the macro. One thing in managed money net positions, we pointed out earlier, hedge funds are quite long, but ETFs have been in significant outflows. They're really just starting to turn to inflows. So I think that's going to continue. You should get some bucking of that bull. But overall, to me, that's a market that's heading towards $3,000 an ounce, and it's probably backing up. Maybe you'll see good support around 2,400.
All right, Mike, thanks so much for joining us. Hey, Mike, you go across the street from the Bloomberg headquarters, Ye Old Watling Pub. Mention my name. They'll take care of you over there, okay?
Done.
Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence. It's a great pub.
I believe you.
It gets a nice little lunch crowd. I'm not a lunch pub guy, but right after work, I'll go over to the Ye Old Watling and pull a pint.
I like the Ned and the cocktails at the Ned, to be honest. I understand. I get it.
We'll go to the Ned for dinner, but you got to have it, after
cocktail.
work with your Bloomberg buddies, go to the Ye Old Watling. It's a good pub.
There was a time you couldn't get alcohol lunchtime in the UK, in London. There was a prohibition from World War II, so the factory workers, the war workers, wouldn't get bombed and
And this is why we miss John Tucker.
Exactly.
He didn't look that up, guys. He just knew it off the top
No, I
of
knew
his
it because
head.
I was there, and they're like, no, but we convinced the bartender to skirt the
He
rules.
wasn't there during World War II, just to be clear. He was explained to him by the guy at the pub. You are so welcome. All right, we'll have more. This is Bloomberg Intelligence.